Well, this is going to be a long video. About 4 hours of this video is a video I had done in the fall of 2023 defending Arbor from a short report, and not one of the low-end short reports like Ninja or Viceroy. Those are too easy to defend against because they're done by less than average people from less than average places. I'll categorize that for you shortly. But it was those two reports were based off a more intelligent report that was done for Value Investor Club. So I attached that video here. It was in the applied level, but it is dated now, so I can release it on YouTube. And in that video, in that 4 hours, I tear apart a much more intelligent short report. Because the other two were derivatives of that much more intelligent one. And if we can, tear down the more intelligent one, then the less than average writers fall by the wayside. May 8th, after the market closed, Arbor put this out, which I thought was odd. But then the next day came a short report. So they sort of knew that the short reporters are just not going away. Let's just read a little bit here. As you may be aware, Arbor has been and continues to be the subject of certain reports by short sellers who frequently make statements that reflect their opinions based on certain select data. And that is true. Even the more intelligent one that we'll read goes from assumptions to conclusions, saying, let's assume this, let's assume that. Here's the conclusions. You can see that Arbor will fail. Well, hang on a second. You made assumptions. You didn't use real fact, but that is what these do. Short reports are written for the height of emotion. They're meant to get you very emotional about what you're holding. And the big emotion that they play on is fear. And that's all it's intended to do. It's written for the height of emotion. So we will tear apart a short report, and I'll show you the techniques that are used in writing a short report to have maximum effect. In light of the current environment and the continued elevated short interest in our company, we anticipate more of these short seller reports in the near future, which may also be featured in the press. In an effort to minimize any confusion in the marketplace or with our investors, instead of responding to each article that cites these reports, we want to reiterate that we stand by Arbor's detailed filings, audited financial statements, and the comments made on our earnings call. Rather than relying on short seller reports or press articles, we encourage everyone to carefully review our comprehensive public statements and disclosures. And I've done that. So the 4 hours that are coming up, it is detailed. But to get that done, I have to do a little bit of teaching in there so that you understand exactly what Arbor's involved in. So we're going to learn something about bridge loans. We're going to understand what a transitional strategy is for multifamily housing, because that's where most of the loans are. We have to understand CLOs, CLO structures, and the surveillance reports put out by the CLO manager, which we will do as well, and have a good understanding of credit facilities and their use and how they are used and what message we can take from them. So we're going to learn a lot about the business that Arbor is in, but we have to. I can't just assume that you know what these terms are, so there is going to be some teaching involved. And then we're going to go through that short report that was put out by the more intelligent person. I say the more intelligent person because where it was placed was a difficult place to put it. And I do explain that in the beginning part of the video of why I chose that one. And if we can beat that one, well, then we can beat these other ones. So I do go through the statements in detail. They are dated in the sense that I'm using the 3 months ended September 30th to get it done. We're 2 quarters past that, but the story hasn't changed. It would be the same story just with different numbers, but the story hasn't changed. The short sellers story hasn't changed, and the business model of ABR has not changed. So we can take away conclusions from this video. Rather than relying on short seller reports or press articles, we encourage everyone to carefully review our comprehensive public statements and disclosures. Our material detail Arbor's continued success in managing through a very challenging environment and demonstrates our ability to consistently outperform our peers. I've been following ABR for God, going on 20 years almost. I thought the great financial crisis would destroy them, and it didn't. I mean, it knocked them down, definitely knocked them down, but they came right back, and they're navigating a very challenging environment right now, and every quarter they keep performing. Every quarter, the market gives them no respect, but that's always been Arbor's downfall, is that no matter how they perform, the market just doesn't seem to give them any respect. But I have been a shareholder for well over a decade in this company, for a very long time, and just the reinvestment of the dividend, that beautiful dividend and the reinvestment over time, it has been one of my, over the long period of time, one of my best performing stocks. Even though the price doesn't go very far, it's just a cash machine for me, and I will continue to hold it. In fact, I've added to my position and contemplating adding more on any weakness. So what we are going to do over the next 4 hours is we're going to look at the best short report there is. Now, when I say the best, I don't mean it's fantastic. It is written from probably the best of the group out there. But it is full of the strategies that short sellers use, which is starting from assumptions and jumping to conclusions without using real data. And it's meant to play on your emotions. When we're looking at Viceroy, I do have 2 videos on my YouTube channel now. If you search my channel for ABR, you'll find two videos on short reports from ABR, one from Ninja, which I made quick work of, and one from Viceroy, where we actually looked at the people involved here. These are not the best of the best, okay? The best of the best are A students from Tier 1 schools. Those are the best of the best. Those are the ones you want to hire. Average people from average places are B students from Tier 2 universities. Good workhorses, good soldiers, but probably not very good lieutenants. And then you have the below average people from below average places. These are your C students from Tier 3 schools. That's Viceroy. These are below average people from below average places. I've already got a video on my channel about who these people are. So I do encourage you to watch it, in case you think I'm just saying this because they're being negative about a company that I love. Actually look at the people, and you'll see that these are, people you probably wouldn't give much time to. And if you read their report, you can tell very quickly they're not very well educated. It's the worst, some of the worst grammar you've seen, and all hyperbolic statements. Anyways, with that, let's just move into the next 4 hours here. Okay, in this video, we are going to tear apart a short report on Arbor. Now, there have been a couple. One that we're not going to get anywhere near is Ninja. That was earlier in the year, and it was pure fabrication. So there's really no point in spending any intellectual time on that one. There was one written in the summer, which looks like it was driven by probably the best intellectual horsepower of the 3. And since we don't know who is behind it, we can only look at the source that it came from, and the source has a lot of credibility. And then there was Viceroy. Viceroy was designed entirely to appeal to your emotion, very light on understanding of what's going on with Arbor. Let's have a look at the one that we will be refuting. Value Investor Club. If you Google Value Investor Club ABR, you'll find it right here. This is their landing page. Here it is right here. And there's some other discussion of it from Barron's. Even Wall Street pros have a tough time getting into this. Value Investors Club is the rare medium where partners at hedge funds will anonymously discuss stocks with investors they know nothing about. From Wall Street Oasis, becoming a member is rather difficult. Know some smart investors who needed 5 to 8 times though VIC is very useful. Here's another one here. Value Investors Club, founded by legendary investor Joel Greenblatt, is an anonymous elite value investing. And you can click on some of these to learn more about Value Investing Club or Value Investors Club. But here's the report right here, Arbor Realty Trust. And all we have is a screen named CFA Venger, which is CF Avenger or CFA Venger. I imagine if you're using the CFA in the first three, that there's a high probability we're dealing with a charter holder. And as we read it, it's written not in a hyperbolic way, although it does use hyperbolic language. Hyperbolic language is extremely excessive language, saying things like, nobody's ever going to buy houses anymore. Well, I mean, that's clearly not true. I think what you mean when interest rates are high is it's going to hurt housing sales. But, you know, some people who want to tell you there's a housing crash coming will word it as nobody's going to buy houses anymore. That's hyperbolic language. When you see hyperbolic language, stop reading, because the language is not designed to inform you. It's not designed to appeal to your rational side. It's designed to appeal to your emotional side. If you Google Viceroy ABR, you'll find this one, Slumlord Millionaires, and you will find almost instantly it is pure hyperbole, pure hyperbolic language. We're not going to tear this one apart. It would be too easy. And you wouldn't learn very much because it would be too easy. It would be so easy. What we'll do is we'll tear apart the other one. That will be the tough one. If we can tear apart that one from Value Investor Club, after everything we just saw on the search landing page of how hard it is to get in, it's Wall Street pros have a hard time, founded by Joel Glenn. If we can tear apart that one, this one here will fall by the wayside. But you can see in just some of the language here, it says here, investors in bridge financing, underwriters and their portfolios of loans appear to be similarly unprepared for the enormous wave of maturities which cannot be refinanced, not true, and are substantially all underwater, not true. In the industry plagued with delusion and bad decisions, Arbor stands out as the worst of the worst. Suggests its entire loan book is distressed. No, it's not. Underlying collateral is vastly overstated. No, it's not. That's a misunderstanding of how these loans are made and what is in these loans. These loans do not qualify for refinancing anywhere. That's not true. And substantially all mature within the next 18 months. That's not true either. So it would be so easy to tear this one apart, because in that first paragraph, I could demonstrate that all of it is false. And if all of it is false, why continue on? We would get to page 3 and say, okay, we're done with this. So we are going to tear apart this one. What I want you to do, it's not long, by the way, and I'll tell you where to get these. These are part of the collateral manager's job to produce these. All the way through, I'll show you where to get these and where this information has come from. And we'll go through all of this stuff, paragraph by paragraph, until we get to about here. From here on in, this is where the author says, okay, so based on what I've said so far, let me give you some projections. I don't think we need to get here. If we can show that all of this up here is what I think is the author's best understanding of what's going on. If we can demonstrate that the author's understanding is wrong, is off base, then all of the conclusions must be wrong. And that is what we're going to demonstrate. Here's what I want you to do first. And this is important. If we are going to learn about short reports, if you feel in your life that, you know what, I like the short side, I really do, then you have to know how to write a short report. You can write to appeal to the greatest audience, which is the institutional investor. If you can get the institutional investor on your side, they will sell their shares. That's the bigger payoff. If, on the other hand, you don't have anything and you're just trying to do a short and distort, which is what Viceroy is known for, where you don't have to tell the truth, You're not writing for information, you're writing for the height of emotion, is you want to instill within that person an emotional response. An institutional investor reading this would get probably a page and a half in and say, okay, I've had enough of this. It's bad grammar, it's spelling mistakes everywhere. This is laid out and written. As I was reading, I was thinking, this is what I would expect from a first-year university student running a solid C- average, is I would expect this kind of work. It's uninformed. It lacks intelligence in both its presentation, in its prose, and its understanding of any of the things that it's talking about. Now I'm speaking hyperbolically. But once I arm you with an understanding of Arbor, I want you to read this one on your own. And it will jump out at you very quickly that you shouldn't even waste your time on this. You're really just wasting your time on what is just a fairy tale. This one here, I want you to read this one. Read it first. And by the time you get to about here, you will want to sell all your shares of Arbor. You'll read it and you go, oh my God, this guy's right on. I mean, all of this makes a lot of sense. You're right. I better get out now, and I better get out fast. You're going to want to sell all your shares. Don't. I want to demonstrate to you how we tear this apart. The reason why it's important to read it first is I want you to feel that feeling. If you have shares of Arbor, I want you to feel that feeling and note it. Say, okay, this is what a short report is designed to do, is bring the emotion out in me. And it will. And the way that you write it, there is a strategy to writing these things if you want to get other people on your side, if this is your goal. Hit pause, search for Value Investor Club, ABR, and just read this. It's not long. But it is important that you read it first, because you must know how you feel after you read it so that you know how other people, how other investors feel when they read this stuff. Okay, let's just get a high-level view of the balance sheet, understand what we're looking at when we're looking at the balance sheet, and I'm going to draw you to this word consolidated. This is a consolidated balance sheet. That means that not all the assets and not all the debt belong to Arbor. But under the rules of accounting, it had to consolidate everything. First thing that we want to know. Let's look at assets. Note the cash and cash equivalents that Arbor has available. That's $900 million in cash and cash equivalents. And if we listen to the second quarter and the third quarter conference call, we will learn that they are not making any new loans in this current interest rate environment. So they are building up cash reserves, $900 million of cash reserves. Why? We'll see a little later why you would need some liquidity and some cash reserves. Look at the next line, restricted cash. Before we move on, cash and cash, we'll notice it went from $534 million on December 31st up to $900 million September 30th. So it was an increase of cash. They are fortressing up their balance sheet. The restricted cash went from $713 million down to $419. The restricted cash is restricted to the CLOs. So when a loan prepays, they can pay out the CLO, and some of that restricted cash is released to pay out the principal on the CLO. So this 419 offsets the CLO balance here of $7 million. There's $419 million in cash already there to meet the $7 billion. So that's really, you can think about it net as $6.6 billion. So when we talk about the value of the collateral is close to $8 billion. So it's not $8 billion against the $7 billion. It's $8 billion against the $7 billion minus the $420 million, because there is restricted cash already available for it. So that can be released against the current value. This is September 30th against the value of the CLOs. Loans and investments. At the beginning of the year, December 31st, 14.2 down to 12.8. That is a drop of 13.62 billion in 9 months. That they were brought down the loans and investments by 1.362 billion. Here is a breakdown of the loans and investments, how we get to the 12,892. The big number here is bridge loans. The other ones are small. The mezz loans are small, preferred equity, other loans, these are small. There's your allowance for credit losses. We're really just going to pay attention to the bridge loans here because that is the focus of all the attention, are these bridge loans. $12.8 billion. But hold on now. Arbor doesn't have that much in loans and investments, and it does not have that $7 billion in debt. Principles of consolidation from Arbor's statements. The consolidated financial statements include our financial statements and the financial statements of our wholly owned subsidiaries, as they should. Partnerships and other entities in which we own a controlling interest, yes, which it should, and variable interest entities. They're your CLOs. So what you do is you set up a VIE, a variable interest entity. You might know it as a special purpose entity or a special purpose vehicle. If you have been through the CFA program, level 1, asset-backed securities, this is what this is. Then off of the balance sheet, you will transfer into the special purpose vehicle your loans. And bonds are sold against this, and all the cash is returned to the sponsor. So the sponsor will retain the equity portion of these bonds. And retaining the equity portion, you now have to consolidate. So there's about $8 billion in collateral backing $7 billion in loans. So $8 billion of that, call it $13 billion, 12.8, let's round it up to 13. 8 of the 13 doesn't belong to Arbor. That $7 billion over here doesn't belong to Arbor. It's just consolidated. It's not their debt. It's the debt of the bondholders, not Arbor. You can cross that line right off. Now Arbor holds this, the equity portion, which is about $1.4 billion across all the CLOs that they hold. So if it were unconsolidated, we would expect to see under assets investments in CLO securities, $1.4 billion. But since you have to consolidate, once you consolidate, you'll have investments in CLO. This number over here would have been $8.4 billion. 8.4 billion. Let's keep reading. Let's see. VIEs of which we are the primary beneficiary. Entities in which we have a significant influence are accounted for under the equity method, as opposed to controlling interest. Our VIEs are described in note 14. It's this last line here. All significant intercompany transactions and balances have been eliminated in consolidation. So because Arbor's balance sheet would have had 1.4 and the liabilities would have been 8.4, since this is an asset of this liability, this 1.4 would have been canceled and this would have just been listed at 7. This being purely, none of that belongs to Arbor. That is purely the bondholders of the CLO. That $7 billion is not Arbor's debt. So when we look at the allowance for credit losses of $184 million, it's not $184 million against $12.9 billion. It's $180 million against 12.9 minus 7, or $5.9 billion. So the $184 million is against just their share. Because if these CLOs go to hell, Arbor doesn't lose $7 billion. The bondholders lose $7 billion. If it all goes to zero, Arbor just loses the equity portion of what it had in there. It loses 1.4, but it's already have reserves of $184 million against it. But again, now it's got to go. Well, it doesn't have to go to zero for Arbor to be wiped out. When we get to the waterfall structure, I'll explain that. But we want to understand what we're looking at on the balance sheet. Let's have a look at our liabilities for a bit, and then I'll come back and talk about this. Look at credit and repurchase facilities, $3.8 billion down to $3.3. So it was able to lower its these are repos. We'll have a look at that, note 9. It'll give us due dates and extensions. It was able to lower it in the first 9 months by $450 million. CLOs started the year at 7.849, ended at 9 months at 7 billion. So was able to decrease the amount of the CLOs by 844 million in the first 9 months. And for senior unsecured notes, which is Arbor's debt, was able to decrease it by 53 million the first 9 months. All in all, you had a reduction in liabilities of 1.35 billion. in the first 9 months, a reduction in loans outstanding of 1.362 billion in the first 9 months. It's bringing down the amount of exposure it has in loans, bringing down the amount of exposure it has in liabilities, and building cash. What does this line over here do from related party? When we look at the cash flow statement, one of the things you may point out is, hey, listen, cash flow from operations doesn't cover the dividend. And yeah, it doesn't, but there's a line item in cash flow from operations of an increase in a receivable. This was due to timing. This payout, this 211 million, landed October 1st. Well, these statements are September 30th. So it was on September 30th, it was a receivable. On October 1st, it was cash. So you would add that 211 back to the cash flow from operations. When we look at cash flow from operations, we should see a line item reducing cash by 211 million. On the third quarter conference call, that was cleared up by the CEO, saying it was just a timing issue where the payment actually landed on October 1st, but you know, you're not going to get away with saying you had it October 1st. You can't. So you had to set up a cash flow issue on that one. So there we are. Understand, of course, that this $7 billion does not belong to Arbor. Arbor has no exposure against that $7 billion, and only roughly 5.9 billion of the loans belong to Arbor, which are financed with 3.391 and 1.32 billion in debt. There's 900 million in cash. There's 420 million roughly in restricted cash against the 7 billion over here. It's consolidated. That's why, right? It is consolidated, so that's why it appears here. For the assets here, the bridge loans, they're mostly multifamily loans. There's 311 loans in here that are single family residential. In other words, just a single house, not multifamily. 1.16 billion of this amount is in single family residence, 311. They do have a commitment to go up to 2.05 billion on this one. So they can finance more. They've just chosen not to at this point in time. They're not issuing any new loans at this point in time. They're mostly multifamily. Our focus is going to be on this category and on this particular type, multifamily. Now, it is mostly transitional. That is their business model, mostly transitional. So let me set the stage for this. Let's say there is a group of companies. Let's say I'm going to draw a circle at the top here. There's a portfolio, and there are a bunch of companies in this portfolio. And I ask you about the value of investing in this portfolio, and I tell you all of these companies are not profitable and they're cash flow negative. What do you think? And you would say, well, but like, hang on a second, they're all unprofitable and all cash flow negative. Why would you invest in a portfolio of assets like that? Those assets would never qualify for inclusion in the S&P 500 because there is a profitability requirement. So you're saying, okay, well, let's put a benchmark up, which is the S&P 500. And you say, well, it has certain characteristics that have to be met to be included in the S&P 500. This portfolio does not have it. I mean, if I took a sample of some of the companies in here, I would say, look, we're dealing with cash flow negative companies and unprofitable companies. What, are you kidding me? Forget it. What if I told you this was venture capital? Oh, okay, well, that's what you would expect to see in venture capital. Why didn't you start with that? That's what you would expect to see in a portfolio of companies that are venture capital financed. They would be cash flow negative. They probably would be profitable. But they have some growth, they have some strategy that they're executing on, so as each year goes by, they get better and better towards their growth. All big companies today were at some point venture capital backed. Why didn't you start with telling me that first? Comparing it to the S&P is nonsense at that point. The S&P is stable, profitable companies. These are early stage companies. You can't compare the two. I think you would agree with that, right? Good. I'm saying good because I'm thinking, who would disagree with that, right? You would agree with, well, that's what venture capital does. So if we looked at venture capital portfolio companies, we should look at them knowing that they're venture capital portfolio companies and say, well, this is what we would expect to see. These are mostly transitional. Well, mostly transitional has a certain profile. So you have to look at these transitional properties in through that lens. You can't look at them and say, oh, these are nowhere near ready to enter the S&P 500. Well, no, of course not. Nobody's saying that they are. But come back in 3 years, and who knows, one of these companies may be going IPO for 20 billion or 30 billion. Well, it's with these transitional properties that if you look at a portfolio of the transitional properties, you would say, they don't look that good based on the metrics that are needed to enter the GSE. Well, the GSE is the S&P 500. And the assets in these that are backed by these bridge loans are mostly VC companies. You can't compare the two metrics. I will show you how that is conflated in the report. Good. I think we're ready to go. We need a small little tutorial about what a CLO is and how CLOs work, and then we'll be ready to tear down some of that report. Okay, let's start by making a bridge loan, a typical bridge loan that Arbor would make. First of all, let's define what bridge loan means. Let's say that you want to buy a multifamily unit. You see some opportunity in it, but you don't have the ability to qualify for an agency mortgage on this building. So you have to get some kind of financing to get through a period of time where you can improve the building to the point where you can get that type of financing. So a bridge loan is just that. It's a bridge from today to tomorrow. How long do you need to get the building ready before we can then move you over to the GSE? So they're typically 3-year terms. Not always, though. Some buildings aren't as transitional. You know, you can look at some and say, well, yeah, you're going to need some time, but you don't need 3 years. We think you can get there in 2 years. So sometimes it's 2 years. And they all have extension terms, 1-year extensions, anywhere from 1 to 3 1-year extensions. Not a 3-year extension, but a 1-year extension, and at the end, a review, and maybe the second 1-year extension, then maybe the third. The typical borrower here is a property management team or a property management company with a track record of execution. If you speak with any venture capitalist, they'll tell you that they invest in good management teams. And they'll tell you, a common saying is, it is better to invest in a grade A management team with a grade B idea than it is to invest in a grade A idea run by a grade B management team. A great property management team can take a bad building and make it better. But a bad property management team can take a good building and destroy it and can make it actually worse. So you need the proper management team, much like a venture capitalist would look at the management team. So does Arbor. The typical collateral, Class C properties, not always Class C, but Class C, is quite common because these are transitional properties. So they tend to be older buildings that have suffered economic obsolescence. Economic obsolescence means the newer apartment buildings or multifamily units being built have a lot more amenities. They have pools, they have gyms, they have tennis courts. These older buildings don't have any of that. So they're not going to get the market rents. So typically their rents are way below market and much lower occupancy. Now, later on in the report that you read, much will be said about where rents are going and the rent growth, which is true. Rent growth in the U.S. has slowed. It's flatlined, and in some places rent growth is actually negative, so that rents are dropping. But what is missing is the statement median rents. When all of those statistics are shown, they're showing median rents. Median rents is the rent in the middle of the market. These are not median rents. These are below market rents. So the strategy is unit capex. We go into each unit
We upgrade the bathroom, upgrade the kitchen, upgrade the unit so that we can then raise the rent from below market rent. So even if market rents are falling, since you're way below market rent, the CapEx alone will justify a rent increase. Much is said in that report that, oh, they're not going to get the rent increases they want. These business plans are flawed. Well, not if you start at below market rents. Point number 2, recycle the tenant mix. So you raise the credit quality of the tenant. There are 2 things to look at when you buy a transitional property. There is what is called the physical occupancy, and there is something called the economic occupancy. The physical occupancy is, well, the building has 100 units and 70 of them are occupied. So 70% occupancy. But of the 70, 20 are not even paying their rent. So economic occupancy is 50 over 100 or 50%. So usually when you take these buildings, you move in, there's a period of eviction. So if we look at the occupancy on day 1 and it is 70%, and we look at the occupancy, the collateral manager looks at the occupancy 6 months later and sees that it's 50%, you may have the impression that people are moving out of these buildings. Well, no. No, the 70% was physical occupancy, not economic occupancy. That if the occupancy rate was given as economic occupancy, you would see that it had not changed at all. So we must be aware that there's a difference between physical occupancy and economic occupancy. And when the management team takes over the building, they will evict and begin CapEx on those units, which means in the first little while, it will look like things are getting worse, that the occupancy is actually dropping. We got to be careful about that, right? We have to understand how this business works, and we would say, well, we would expect to see that. Again, if you think about venture capital has a timeline. They invest at this point in time. It's quite normal to see this kind of thing on the return stream. This is called the J curve. If you've ever seen that, you would expect that the first 2 or 3 years that your returns would be negative for a period of time, because these companies take time to ramp up. They will be burning cash for a couple of years. You have to expect that. When you understand what business you're in, you can then understand the characteristics of the investment that you made. We got to pay attention to economic occupancy, not physical occupancy. Problem is, we don't have data for economic occupancy. We just have to be aware that, hang on, there's a difference between physical occupancy and economic occupancy. If my building is got everybody in every unit, but only half the people are paying rent, I, in essence, have 50% vacancy, do I not? Right? So you're going to recycle the tenant mix. You're going to raise the credit quality of the tenant such that the physical occupancy begins to match the economic occupancy, and then you're going to lease up. That is called stabilizing your net operating income. That's the goal. We're going to find a building where we say, you know what? Look at this building. It's only 70% occupied. We can go in and we can really upgrade these units. We can change the credit quality of the tenant because we'll upgrade the unit. It'll be a higher cost. We got to get rid of a lot of people first. You can't recycle and upgrade your tenant with all the old tenants walking around. You really got to go in and clean house. And then we'll lease this thing up and increase our NOI. So we will increase our rents just due to the CapEx, and we will increase the credit quality of our tenants so that our physical occupancy and our economic occupancy are the same. And we get to what's called stabilized NOI. I want you to pay attention to this word, NOI. This is what we would look at. As we go through the report, we will see that there is a substitution for NCF, net cash flow. Net cash flow is not net operating income. We've got to be careful about that, because if you're doing the debt service coverage ratio, there is a big difference between what is NCF and what is an NOI. You can't calculate your debt service coverage ratios with NCF, but NCF is reported. And debt service coverage ratios are calculated based on NCF. Well, that's not the right way to do it. We will make an adjustment for how to do it correctly. Okay? So let's look at a common structure of a bridge loan, because this is the business plan over here. when we look at venture capital, they may step in and say, okay, this company needs $100 million to get to scale, but they never finance at $100 million. They do Series A, which might be 10 million. And then there are certain milestones that this company has to meet before it unlocks Series B financing, and it has to raise its valuation. Well, if you're doing bridge loan financing, and this is the goal over here, and you're going to forward, I give the example here of a $50 million loan, you don't forward $50 million and let the management team do what it wants to do. The common structure is some of the loan we give you will be to acquire the building. How much equity have you got? You need to put in your own equity, okay? How much have you got? Good enough. Then we're going to set up a capital improvement reserve. In other words, you can draw upon this reserve as you improve each of the units, but it's reserved. We're not going to put it in your general operating account for operating funds. That's your problem. This is specifically for capital investment. You say you're going to do that, we will put a structure in the loan that says these funds are only for those purposes. Then there's going to be a debt servicing reserve, kind of like working capital. Think about financing a venture capital firm. You know it's going to have cash burn. It's going to have to invest in growth. But at the same time, it has to pay bills. So some of the financing must be for working capital. Well, that's what this is over here. It's saying, look, we get it. In the first year, you're going to clean house. You're going to evict. Your cash flows are going to drop significantly, and you'll be investing in CapEx. At the same time, you have an interest-only loan. These bridge loans are interest-only. You have an interest-only loan that you have to pay. We don't want you to get into trouble because of a constraint on working capital because of what you do. So some of the loan will be for debt service reserves so that you don't go into default early in the process, which it's perfectly normal in these transitional buildings to be cash flow constrained for the first year. This is part of the business plan. So there's going to be a debt servicing reserve. And listen, these are floating rate loans, so why don't you put some interest rate caps in place? And that's all. That's part of the loan. The proceeds of the loan will pay for the interest rate cap, but it's got to be in place. In some cases, it is an obligation that you can't get the loan without the interest rate caps. Arbor reports that about half of its bridge loans have debt servicing reserves, and about 70% have interest rate caps. And in some cases, there's an overlap. If 50% have this and 70%, there's 20% that have both debt servicing reserves and interest rate caps. So as the interest rate goes up, Arbor receives the higher interest rate. However, there is a cap in place where the counterparty of the derivative, pays the borrower the difference. So the borrower interest rates will go up, the borrower would be capped, Arbor gets the full amount. This is paid for by the counterparty to the interest rate cap. So there are interest rate caps in place. Okay? Let's go through an example here. Let's say there's a $50 million loan, and I'm going through this example to show you how the loan-to-value ratio is not calculated correctly. Right off the top, it's not calculated correctly. $50 million loan. Let's use this common structure. $45 million and borrower equity is for acquisition. We'll assume that the property is $60 million. We're going to lend $45 million against that 60 for acquisition, which down here, 45 over the 60, gives a 75% loan-to-value ratio. $4 million is a CapEx reserve to draw on, and $1 million is a debt service reserve to augment working capital. The wrong way to calculate the loan-to-value is say, well, you lent $50 million on a building worth 60, your loan-to-value ratio is 83.3. It's like, no, I lent $45 million to buy a building worth 60. This is a CapEx reserve, which they haven't drawn upon yet, and this is a debt service reserve, of which it's owed to me anyways. I mean, they can use that to pay me. So it's not part of the loan yet. This is not fully funded. So the proper way to do it is the 45 over 60, 75% loan to value. We will see when we look at the rating agencies that they don't do this. They assume fully funded. They assume fully funded, so you'll get this when it's actually this. A more correct way to do it here, if we assume the $4 million is spent on CapEx, the $4 million should increase the property value by the same amount of CapEx that you spent. So the loan is 49 against a building worth 64. That's 76.6 loan to value ratio. So number one, calculating the loan to value ratios on the face value of the loan as opposed to the funded value of the loan will massively overstate the loan to value ratios. Now, in most of these loans, we'll see that there is an underfunded amount on all the loans. Underfunded means that, okay, we approved you for a $30 million bridge loan, but we've only advanced $26.5 million because you have reserves. You have capital improvement reserves, you have debt servicing reserves, and you haven't drawn on those yet. So the loan to value ratio isn't as high as what you think it is. However, the rating agencies use fully funded. Whether it's fully funded or not, it will use fully funded. At this point, it may be helpful to contrast some terms here. NOI, funds from operations, adjusted funds from operations, and the use of net cash flow. Let's start with net operating income. We will take our rental income for the unit at full occupancy. So if you have some units that are empty, you will simply assume that they're full, you'll charge a rent for it, and you'll get full occupancy. And you'll add other income to get to what's called a potential gross income. This is what the building could do if it were fully leased. That's the potential. Now we'll take off the vacancy. We'll make an adjustment for what vacancy we have and what collection loss we have. That will be our effective gross income. Take off your operating expenses, you get to net operating income. Notice that there are no financing charges in getting to net operating income. To get to funds from operations, we will start with net income. We add back depreciation and amortization, and then you adjust for the losses and gains from sales because they are accounting losses or gains, and you'll get your funds from operations. If you subtract your non-cash rent adjustments, any recurring maintenance CapEx, notice now for the CapEx, it's recurring only, any recurring maintenance CapEx and any leasing commissions, you'll get to adjusted funds from operations, also called FAD or CAD, funds available for distribution or cash available for distribution. And then you calculate your debt service coverage ratio by taking your adjusted funds from operations, which is your cash available for distribution, and it's available for distribution to the providers of capital coming from either debt or equity. Take your adjusted funds from operations divided by the actual interest expense. There is your debt service coverage ratio. How Morningstar does it is it uses net cash flow, which is net operating income over here, net operating income. From that, it's going to subtract all CapEx, not just maintenance CapEx, but tenant improvements as well, and leasing commissions. So there's the leasing commissions there, and it gets to net cash flow. Then the Morningstar debt service coverage ratio has net cash flow in the numerator. Again, no financing charges in that. The financing charges are in the denominator. You divide it by interest expense, but this is an interest expense with a stressed interest rate on the fully funded balance, not the as-is balance. I think you can see the difference between the two. The big difference here, tenant improvements and in the interest expense. This is using a stressed interest rate. This is using the actual interest expense. This is using a stressed interest rate on the fully funded amount. Again, this is just the actual amount that is being incurred. And we're taking off tenant improvements, whereas adjusted funds from operations just uses recurring maintenance CapEx only. So the two ratios, you would have to adjust the two ratios for the tenant improvements and the fact that we're using a stressed interest rate. Okay, let's look at the timeline. There's a 3-year timeline, and let's look at the evolution of the loan to value ratio over time, and let's assume we start at 85% loan to value. Let's do it aggressively. In the first 12 months, what would we expect to see? What would be a normal profile? Well, you're going to have, as soon as you start with the building, you're going to have evictions, renovations, and lease ramp up. For evictions, some regions, very difficult. If you listen to the Q1 conference call, the CEO tells you that in some regions it is still very difficult to evict people, still a remnant left from COVID. But that they are working on ways to get that done. But some buildings in some regions are very difficult. And that, again, that sets up the difference between economic vacancy and physical vacancy. And in the regions where it's very difficult, it will cause left tail migration. And left tail means that you won't follow this loan to value ratio, but it might look more like this, right? You'll be in the left tail over here, but there are still remedies if you end in the left tail. There's extensions, there's lease modifications, and in the worst case, foreclosure and sale. And ABR has done all of those at some point in time on loans, because much like a venture capitalist will tell you, not all their companies will be successful. It's the same thing here. Not all the management teams will be able to execute. Sometimes you make a mistake. Sometimes you invest in the wrong team, and when you invest in the wrong team, it's nice to have tools available like the foreclosure. And we'll see that they did use the foreclosure in one particular case. But this is what we would expect to see. That if the collateral manager checks back in 6 months, this would look like it's getting worse. And somebody who is reading the surveillance reports from the collateral manager, and we will read some, would say, look at this one, for example, it's actually gotten worse. And look at this one, it's gotten worse. Yeah, that's the business plan. That is normally expected to be seen. This is the typical evolution. Much after 12 months, the loan to value ratio starts to decline, because you are leasing up, and as you're leasing up, you are increasing the value of the property. The CapEx is increasing the value of the property. And sometime around a little after 24 months, your unit turnover should have been more than 60%. Multifamily units turn over about 30% a year, which means the tenant mix changes by about 30% a year. So it usually takes about 3 years to completely change the tenant mix. In case you think that sounds aggressive, imagine a building with 100 units. Some of you might have lived in apartment buildings before. At the end of the month, it's not uncommon for one of the elevators to be booked for a couple of days, the service elevator. 2, maybe 3 units change at the end of the month. Somebody on 8th is moving out, and somebody on the 2nd floor is moving in and moving out, and 2 people are moving in. Well, if it's only 2 a month, that's still 24 a year. That's 24%. You see, it doesn't take much to get to 30%. The typical turnover on average in multifamily units is about 30% a year. So by the end of the 2nd year, you've got 60% of your units that have turned over, which means that you have upgraded 60% of the units and upgraded the tenant quality in 60% of the units. So you should be moving closer towards your stabilized rent. Stabilized meaning your rent per unit and vacancy rate. You should have been increasing your rents, even if market rents are coming down. Keep in mind, these were not market rents. These were below market rents, so they should be going up. We should get that information from the collateral manager. So we will look at the surveillance reports, and we will see that across at least the ones that are reported, because they are sampled, we do see rising rents. And we do have the market rent. We see, even with the rising rents, we're still way below market. So the idea that these property managers won't be able to raise rents, no, the increase in the rent is based on raising the economic value of the unit towards the market rent, not hoping market rents go up. So a certain rent per unit, certain vacancy rate, and as you near there, by the end of the term, the business plan goal is that you are moved to a GSE CMBS. Now, Arbor gets origination fees, they get the mortgage servicing rights, and they make interest on escrow balances, because they bring them to the CMBS, and then they service the mortgage. So not only do they make a return on the bridge loan, they then create their own inflow into the GSE program that then they benefit from. So let's look at this here for a moment. This is a point estimate, right? This is the goal of the business plan. Some will do really well, some will not do so well. So you have some distribution of outcomes. Let's say that you have some normal distribution. Anything in the right tail is ready to be transferred to the GSEs. And we'll see that Arbor has been very successful over the years at transferring loans in their portfolio to GSEs. And we'll get this with the surveillance report. We can look at the CLO surveillance report and we can see how many of the original loans and how many of the loans that were turning over were transferred out, how many were actually taken care of, and it tells us of those loans, how many of them did Arbor actually have to buy themselves, because that's usually a sign that something is wrong with the loan. We get that in the surveillance report. We can clearly see it, so we'll have a look at that. Now I've drawn a normal distribution. There is a lot that Arbor does to change the shape of that distribution. Again, if you have a great good management teams that are doing these buildings, that are transitioning these buildings, the management team that has execution ability will end up here more often than not. So if you have good execution, you'll have positive skew. This is your left tail, this is your right tail, and here you do have some remedies for you here. You have extensions. If it's a good management team, and they ended up in the left tail, they're not ready to move to the GSE, it could be that, well, you know what, it's the region that you're in. They won't let you evict these tenants. Sometimes you got to pay the tenant to get the hell out. You got to knock on the door and say, I'll give you $5,000 to move out. I'll give you $10,000 to move out. Sometimes you got to pay these people who are living there, sometimes for years on end without paying rent. You got to pay them to get out. Now, I want you to think about the region or the county or the government in that particular area that says, even if they're not paying you rent, you can't kick them out. You know, there is a property owner. It seems a little unfair, but sometimes you got to pay to get rid of. There's always a solution. So it could be an extension if it's a good team that's executed, but it has some exogenous unforeseen problem. There could be a loan modification if the environment isn't friendly to the type of loan that's in place. Say, okay, well, I'll tell you what if we modify the loan and you use the extra proceeds that you would pay us to do some other things? How does that sound? And finally, if you find, okay, you know what, this should have been a home run for you and you messed it up. You messed up a good opportunity. You guys suck. Then you could just simply foreclose and sale, or do what's called a credit bid, foreclose and re-own it, and then sell the building to another good management team. It is important to understand that Arbor owns the loans. It does not own the properties. Arbor is not a landlord. It is a banker to landlords. It does not own the buildings. All right. Now, if you have poor execution, yeah, you're going to have a lot more that end up in the left tail. So if you don't care about the type of management team and you only say, well, that's a good building, you go ahead, and that's a good building, and you go ahead, you miss the point. You have to say, you're a good management team, it doesn't matter what the building is. And you're a good management team, it doesn't matter what the building is. You guys have a track record for getting this done. I'm going to back that horse. You will develop this type of distribution. How do we know if we have this type of distribution? The surveillance report at the very end tells us how many of these loans that were brought into the CLO migrated out of the CLO. We'll know what the turnover is. We'll be able to judge the success of these things by looking at the surveillance report. And we'll have that available. I'll explain when we get to them where to find those reports. Okay, now that we understand what the bridge loan is, remember the bridge loan is for acquisition, will have a capital reserve, a capital spending reserve, and we'll have a debt service reserve all within one bridge loan. Let's figure out what a CLO is, a collateralized loan obligation. It is secured by all those bridge loans. Now, what we've already noted is the collateral is non-stabilized. It's transitional. So the collateral is not stabilized because of that transitional strategy. The CLO is tranched. There are investment grade bonds, high yield bonds, and an equity tranche. The equity tranche is typically retained by the sponsor. ABR retains the equity tranche, and in some cases may even retain some of the high yield tranches. So the better it feels about the type of collateral going in and the environment, the more likely it is to say, why don't we grab the high yield? I mean, why not grab the high yield? They typically have a 180-day ramp up. So let's draw a timeline, and here is the CLO date. For the first 6 months, you have to add loans to it, right? So let's say that you have a CLO, you set up a special purpose entity or a variable interest entity with an authorized amount of $2 billion, and the initial pool of loans are $1.4 billion. Now, of this $1.4 billion on the loans, it represents the current balance and the future loan commitments. It's the fully funded amount, not the amount that has been forwarded. So maybe out of that $50 million loan, let's say there's a $50 million loan in this 1.4, only 45 has already been advanced. 5 has not. This is non-interest bearing. Okay, the unfunded part of the loan is non-interest bearing. Only this part is interest bearing for the CLO tranches. Only that part is interest bearing. And then you have, if it's $2 billion, you have 1.4, you have $600 million to be determined. The collateral manager buys the loans. So you have to bring the loan to the collateral manager. It will look at the qualities of the loan and say, okay, we need certain loan to value ratios, certain debt service coverage ratios to be included in the CLO. This one passes, off we go. And the collateral manager does the due diligence on it. So you got to get a loan past the collateral manager. It's not as if ABR can shove anything it wants in there. It's got to get it past the collateral manager, because the collateral manager is representing the bondholders and is not working for the sponsor. So you have to get it past that person. All of these loans that you want to transfer in that initial pool have to satisfy the collateral manager. Now, after that ramp-up period, that's it. So if you don't get to the $2 billion, let's say you get to $1.7 billion, well, then it's over. It's locked. It's a $1.7 billion CLO and not a $2 billion. Then you'll have a period, either 24 or 30 months, where you can recycle capital. So we'll say a 30-month period. That means the first 3 years you can recycle capital. What does this mean? That means as loans are paid from the pool, the principal is not returned to the CLO holders. The proceeds are used to add more loans. You're recycling. So you may have a number of loans that go in to the CLO, and 3 years later you say, well, there's 40, let's say 2.5 years later, you say there's 45 loans in there. What you cannot do at that point is say, oh, there's only 6 months left on these loans. No. You have to look at each loan, because one of those loans might have just come in. So let's say that you have loans leaving and new ones coming in over this ramp-up period of time. And at some point, you take a cross sample of these loans and you say, well, let's just see what the qualities of these loans are. Well, you've got some good loans and you've got some ones that just came in under the transitional strategy. You have some that are nearing stabilized rent and some that are far from stabilized rent. And then you're going to do a cross section of that and compare it to the requirements for the GSE. Well, you can't do that. You can't do that because you're mixing the maturity of all of those loans. If you're going to look at the collateral in terms of the success of the business plan in a CLO, you have to say, well, how many of these loans are less than a year old? How many are between 1 and 2? How many are between 2 and 3? And you have to look at them as different buckets. The loans that are less than a year old won't look good compared to what the GSE requires, but the loans that are at least 2 years old and less than 3 should look good, so that if you're comparing the success of the program, you have to look at those that are nearing their stabilized rent, right? So you have this capital recycle. Then after 3 years, it's locked. And after that, then as the loans mature and move out to either another buyer for the building. Maybe the original borrower said, I'm not really looking to go to the GSE and have a long-term mortgage. My strategy was to buy this building, renovate it, lease it up, and sell it after 5 years. They could just sell it to another buyer, pay out the loan, and it's done. Once the loan is paid out, then all the principal returns to the tranches in a waterfall approach. All the principal goes to IG first until they're gone, then the principal flows over to high yield, then they're gone, then everything else flows through to equity in the end. There are also credit enhancements on the CLOs, which also come with note protection tests. Over-collateralization and the interest coverage ratio. So with over-collateralization, there is a par value trigger. So, for example, the collateral might be 118.8% of the face value of the non-owned, whatever Arbor doesn't own, the non-sponsored owned debt. You must over-collateralize by 118.8. As long as you're above that number, you're good. If you fall below that number, that sets up what's called the par value trigger, and then something happens here. Same with interest coverage ratio. It must be, let's say, 120%. If it falls below that, it triggers these protection tests. If triggered, if any of these two, the over-collateralization or the interest coverage, are triggered, all cash flows to equity stop, which means Arbor receives no more cash flows because it owns the equity portion. All cash flows stop until it's resolved. In the meantime, the waterfall approach is used. All cash flows will go to IG. All excess cash flows, you have to pay the interest on the IG and the high yield. Equity gets nothing. But then after that, all excess cash flow would then go to IG until it's resolved. Now, Arbor is not without recourse. They can buy the loan to restore the equity cash flows. In other words, they can warehouse it. To do that, we have to assess whether or not Arbor has the liquidity to get that done, which means we have to look at its credit facilities to determine how much credit do you have available to you at any time. That if you had to buy a $30 million loan, do you have the funds to do it? Well, what did we see on its balance sheet as of September 30th in terms of cash? $900 million in cash, right? So the question is, well, how often does this happen? How often does Arbor have to buy a loan? The collateral manager produces surveillance reports that tell us in each of the CLOs how often Arbor had to step in and buy a loan. So we can just look at that. We could just say, well, here's the data. What we're going to do right now is we're going to read a pre-sale report. AR for Arbor, CRE, Commercial Real Estate Note 2022 FL2. That is a specific CLO that was initiated in 2022. And the pre-sale report is exactly what it is. It's what the CLO investors would receive. They would read the pre-sale report and then they would make a decision whether or not they want to invest. It's issued by a rating agency. Let's go look at one and I will explain to you where to find these things. Sometimes they're hard to get because they're behind a paywall. You just have to be creative in your search because somebody somewhere has the pre-sale report. Okay, let's see if we can find this. Type in Google pre-sale report, Arbor Realty Commercial Real Estate Notes 2022-FL2. For Morningstar, you'll find everything under Morningstar. Behind a paywall, you're going to need a subscription, so you're not going to be able to get to it. But there are other sources available because other people have received the pre-sale report. This site here, cffassets.net, pretty much has everything we need. There's the pre-sale report. Click on that, and you'll get the pre-sale report. Let's just expand it. So we have 25 pages here. It starts off with the capital structure. So we can see exactly what the ratings of each tranche are. We have some AAA tranches, AA and A, triple Bs, Double B's, B's, and the equity tranche, the income notes. Arbor is taking class F, G, and the income notes of this, and it gives the amount of subordination. So if you're holding let's say all the way up to the triple A's, you can see this number here, 34.875% of the issue is subordinate to the triple A's. And along with the rating, you have a trend: positive, stable, negative. These aren't issued yet. This is the ratings on them, so they would all be stable. Let's look at the transaction summary, which is next. And this gives us a view of what is in this. The initial trust amount is 936 million. In other words, the initial pool of loans going in that has been identified is 936 million. The target pool balance is 1,050 million. So down here, non-interest accruing reserve amount. 113 million is a combination of reserves available and funds that can still be deployed during the ramp-up period to buy more loans. If you add the 136 to the 936, or sorry, the 113 to the 936, you'll get to 1,050 million. Number of loans, 32. Average size, roughly 30 million. Number of properties represented by these, 40 properties. Managed, yes. Pre-identified ramp loans, no. In other words, the ramp-up loans have not been identified, just the initial pool. The RAC, this is a rating agency condition, 500,000. That means that any new loan the collateral manager buys or brings in that's greater than 500,000 has a condition that it must satisfy the rating agency's conditions for inclusion. Par value test ratio is 119.3. The initial par value ratio is 119.3, so it is over collateralized by 19.3% and satisfying the requirement. Reinvestment period here we see is 24 months. So we're going to have a ramp up period, and then you have 24 months where you can recycle the capital, reinvest the capital. Interest coverage ratio, the trigger, this is a multiple. That's what the X is, 1.2 or 1.2 times. So on your debt service coverage ratio, you should be hitting your interest coverage ratio 1.2. These are interest-only loans, so interest coverage ratio, debt service coverage ratio end up being the same thing. The current funded as is appraised issuance loan to value, that means currently funded, and the as-is cash flows that are available on the property, 71.5. Morningstar says it's 76.5, but we will read in the notes that they calculate the loan-to-value and the debt service coverage ratio with some very conservative assumptions. The current funded stabilized appraised loan-to-value ratio, and that's currently funded. In other words, if I've lent you 45 million against a commitment of 50, it's 45. It's currently funded, not the fully funded, 66%. Morningstar stabilized, 68%. The weighted average interest rate margin, it'll be SOFR, 1 month SOFR plus the spread. This is the margin, 3.589. The weighted average interest rate for the CLOs, if you weight all the tranches by the coupon that it gets, 5.39%. Weighted average term remaining, 31.7. This is the amount of time remaining on the bridge loans. But if they are fully extended, if all of loans use all of the extensions they have, 174.4. And then we get into the Morningstar as-is debt service coverage ratio and the Morningstar stabilized debt service coverage ratio versus what the issuer says the as-is debt service coverage ratio is. The issuer is saying 1.35, Morningstar is saying 0.82. And this is where we get the term from the author saying aggressive assumptions being made by Arbor. It's the opposite direction. It's the very conservative assumptions being made by Morningstar. And stabilized 1.13, and here the issuer stabilized 1.42. And the difference comes in the way that they're calculating things. As I explained earlier, the type of interest rate that is charged and the type of CapEx that's reflected in either net cash flow versus adjusted funds from operations. All Morningstar debt service coverage ratios and loan to value calculations in this table and throughout the report are based on the Morningstar stressed interest rate. And at the end of this video, I'll put a little appendix explaining what the stressed interest rate is so that you can see what that entails. Based on the stressed interest rate and the fully funded and extended mortgage loan commitment. The fully funded, not the as-is funded or currently funded, the fully funded, whether they've taken the money or not. And based on that fully funded, again, at the stressed interest rate, the weighted average metrics presented in the table in the report exclude the ramp loan assumptions if applicable. Number two refers to, you see over here, the debt service coverage ratio. And number 3 refers to the stabilized debt service coverage ratio. And they're telling you that based on Morningstar as is net cash flow. And they do calculate net cash flow differently than they would calculate adjusted funds from operations. And adjusted funds from operations is the more correct way that you would use to calculate the debt service coverage ratio, with your denominator being your actual interest expense. And if you want to be a little bit forward looking, you would say, well, your loan is going to increase over the year. Let's divide your numerator by the expected interest expense over the next year at whatever the interest rate happens to be. And we know that Morningstar is using the fully funded and the stressed interest rate for that one. Rating considerations. We'll do a little bit of reading, but I'm going to leave most of it to you to go through so that you know what these things have, but we'll do a little bit of reading here. Initial collateral consists of 32 floating rate mortgage loans and senior participation secured by 40 mostly transitional properties. Initial cutoff date balance totaling approximately $936 million. In addition, there are approximately $40 million of non-interest accruing reserves. We've already discussed what these reserves are, whether they are for capital improvements or whether they are for debt servicing in addition to working capital. $40 million non-interest accruing reserves contributed to the trust, bringing the total reference date portfolio to $976. Each collateral interest is secured by a mortgage on a multifamily property or a portfolio of multifamily properties. The transaction is a managed vehicle that includes a 180-day ramp-up acquisition period and 24-month reinvestment period. So basically 2.5 years on the CLO. For the first 6 months, we're going to add new loans. After that, we're going to lock it. And then for 2 years, if a loan pays early, the collateral manager can take those funds and buy another loan up until 2 years after. After 2 years, if a loan pays, then the capital flows through to the bondholders in a waterfall approach. The highest ranked, highest ranked tranche will get all their principal first, all the way down to the equity tranche. Let's see, what else do we have here? A 24-month reinvestment. The ramp-up acquisition period will be used to increase the trust balance to a total target collateral principal of $1.05 billion. Morningstar assessed the ramp component using a relatively conservative pool construct, although the ramp loans have expected losses that are generally in line with the expected loss levels exhibited by the other loans in the pool. In other words, what they're saying here is that we haven't identified these yet, but they'll pretty much be like what we've already got. They'll be more of the same. During the reinvestment period, so long as the note protection tests are satisfied, that is the over-collateralization test and the interest coverage test, so long as they're satisfied and no event of default has occurred and is continuing, the collateral manager may direct the reinvestment of principal proceeds to acquire reinvestment collateral interest, including funded companion participations meeting the eligibility criteria. So the collateral manager is not free to do what they want. And the important thing here, Arbor is not free to just throw stuff in there. Arbor has to bring it to the collateral manager and say, what about this one? All right, let's look at the eligibility criteria. The eligibility criteria, among other things, have minimum debt service coverage ratio, loan to value, and loan size limitations. In addition, mortgages exclusively secured by multifamily properties and student housing properties are allowed as reinvestment, and student properties only up to 5% of the total pool. Why would we want to cap student properties at 5% of the pool? They have significantly higher turnover because every year everybody moves out. Not only that, they have much higher maintenance capex because student housing is party housing. So much higher maintenance capex. So they are riskier to begin with. Only up to 5%. Lastly, the eligibility criteria stipulate a rating agency confirmation. That's the RAC we talked about earlier for $500,000. Anything over $500,000 must have a rating agency confirmation on ramp loans, reinvestment loans, and pari passu participation acquisitions. That means any loan that already participates equally with another loan that they have above $500,000 if a portion of the underlying loan is already included in the pool, thereby allowing Morningstar the ability to review the new collateral interest and any potential impact on the overall ratings. The transaction will have a sequential pay structure. So there is a lot that the collateral manager has in place to make sure that the loans going in meet the criteria. Arbor cannot just throw stuff in there. We can pass on some of this stuff here. Strength deal sponsor. And this is important. Arbor is got a good relationship in what it does and a good reputation for what it does. It is known as a good operator. The sponsor for the transaction, Arbor Realty, majority-owned subsidiary of Arbor Realty Trust, and an experienced CRE collateralized loan obligation issue and manager. This will be Arbor's 19th post-crisis CRE CLO securitization, including 4 securitizations in 2021 and 1 previously in 2022. In total, Arbor has been an issuer and manager of 18 CRE CLO securitizations. This is their 19th, so that's why you say, I thought it said 19. This is their 19th. They have done 18 already, totaling more than $10 billion. Additionally, Arbor will purchase and retain 100% of the Class F notes, the Class G notes, and the income notes, which total approximately $172 million. Another strength, 100% multifamily. Primarily acquisition financing, 28 loans, representing 85.5% of the reference date portfolio balance represent acquisition financing. This is important. Acquisition financing generally requires the respective sponsors, those are the ultimate borrowers for the properties, not Arbor, but the ultimate borrowers of the property, to contribute material cash equity as a source of funding in conjunction with the mortgage loan, which results in a higher sponsor cost basis in the underlying collateral and aligns the financial interests of both the sponsor and the lender. Business plan score, it goes from 1 to 5. The lower the score, the better it is. They look at the business plan. They say, okay, it's a transitional property. You're buying it. Let's look at your plan. And the closer it is to 1, the stronger they think the plan is. Ranges between 1.4 and 3.2, and it goes all the way up to 5. An average of 2. Average of 2 is pretty good. Under 2 is really good. But this is the thing. If there is a transitional property that has a lot of upside, you don't want all of your business plans to be 1s. In other words, you don't want them all to be home run hits that are so easy to do that anybody can do it. Because there's very little upside in projects that have low levels of risk. So you are going to take on a little bit of risk. So you'll find that in most of the pre-sale reports and in the surveillance reports, their business plan scores will be somewhere between 2 and 2.25 to 2.5, somewhere in there. Now, with the surveillance report, you may think, yeah, but shouldn't it improve over time? Keep in mind that there's a reinvestment period. So in a year and a half, when the collateral manager has a look at the properties, 15 of the original ones may already be gone and 15 new ones may be in. So the good ones keep leaving. So there's the business plan score. Physical condition, and it gives you a breakdown of the type of condition these are in. The loan collateral was generally found to be in good physical condition as evidenced by one loan, 30 Morningstar Drive, making up 3% of the reference date portfolio balance and secured by the property that Morningstar deemed to be excellent in quality. Additional 4 loans, the Julian, Generations, 55 Jordan, and Casa del Encanto and Casa Luna, are secured by properties with average plus property quality and total approximately 23.9% of the reference date portfolio. Everything else is average or average minus. Let's keep going here. This lists challenges and considerations, loan sponsor strength, and then you have mitigants, managed transaction, and some mitigants for that. We don't really need to read that. Legal structure, we don't need to read that. This is comparable transaction. So here is the subject deal right here, and here are the qualities of it. And here are all the comparables. These are ARBRs, the 4 they did in 2021 and the previous one in 2022. And this is the average of all of them so that you could see how this one compares to all the other ones that they have done. In terms of the equity to loan amount, in terms of this is Morningstar's as-is loan to value ratio. You may think that some of these are rather high. Keep in mind this is the Morningstar loan to value ratio, not what we would expect to calculate if we used actual numbers, right? As opposed to stressed numbers. You can understand why a rating agency would want to stress the numbers. It wants to make sure that its rating is going to hold up if economic conditions change. If it's just using stuff that is, okay, this is how it is today. Then every 6 months or so, if you're in a dynamic environment, you'd be changing your ratings a lot. So from the rating agency's perspective, it's let's paint a really stressed picture. And as long as you stay, if the conditions change and you're staying within that, then we don't have to keep changing the ratings. We're going to make it stressed first so that ratings are more stable as opposed to responding to a changing environment, which is why it's difficult to compare the Morningstar statistics, especially on loan to value and debt service coverage ratio, to what actually is in place. Anyways, there's a whole bunch of statistics here that you can look at. As you keep scrolling down, you'll get more that you can refer to. Here's the interesting thing. You actually get the names of the locations. So we can actually Google some of these. We don't have to, if we look at the report from Viceroy, they put a picture up of an example of something and say, look at what these things are. But what they don't show you are all the other places, and we'll have a look at that. We'll scan through some of these. Just take some of these at random and Google them. You can come up with them. What you're not going to find is if you find something like this, the Abbott portfolio. Well, that's the name of somebody, and there's 4 properties in there. It's not the name of the properties, it's the name of the portfolio. You're probably not going to find that. But Harbor Landing, 30 Morningside Drive, the Generations, the Julian, you're going to find those. Google them, have a look at them. We'll have a look at a few shortly. Then they take a sample of the properties, and then they do some due diligence on it, saying, okay, let me see your financials. We got to calculate some things here. What's the net cash flow? Let's see if we can calculate some ratios here, just to see what's in there. So you'll get other names as well. Go ahead and Google them. It is okay to have a look at what they look like. Don't take one picture in one short report that's on fire as an example of what everything is. Go ahead and Google some of these things. Here is your property quality. Notice 60.7 is average. Right? That is the point. These are transitional properties. They are going to be average. But they start as average and they migrate up. They migrate to average plus, and then hopefully they migrate up to good. But this here you have 23.9, which is average plus. You have 60.7, which is average. You have a light blue over here, which is average minus. 11.6 is average minus, and then excellent 3.7. Nothing below average, nothing poor. From average minus up, but usually on all the pre-sale reports you'll look at, the bulk of their properties start in the average category. And then a little bit of discussion going through on how they calculate certain things, and then some other information here. I will leave that for you to read. If we go back to the Slumlord Millionaires one, what they did was they put forth some pictures. They said, here's an example of what we saw. Look at this. This is Latimer Park. Look at what we saw. The thing is on fire. Well, we don't even know if that really is the place unless we actually go and look at it, right? But look at this. Look what's going on. Look at this reading. Do not recommend. Office staff scam you and play with your money to make you pay more rent. This could be one of those ones that weren't paying their rent and were trying to be evicted. Listen, let's say that I want to short Apple. And I go online. Do you think that I'll find somebody who hates the iPhone? Yeah, I'll find a review of somebody who absolutely hates Apple and hates the iPhone. And the review will be terrible. Who is this person? We don't know who this person is. There's no background to this person. There's no veracity to what this person, this is this person's interpretation of events, but this could be someone who's just being evicted. So they take the worst that they could find, and they put it up and try to tell you that this is what's going on. So I could, if I want to short Apple, say, without much effort, for example, look at this review that I found on a large, popular, influential social media site. And it could just be ripping Apple apart. See, what I want to do is I want to take a very left tail example and I want to bring it to the center of the distribution and present it to you like this is what's going on. Why don't we have a look at some of the properties? So what I did was I just grabbed some names at random, put them into Google because we have the name of the properties. Now sometimes you have, it'll say something like the Johnson portfolio. Well, we don't know the names of the buildings in the Johnson portfolio, so we can't get much. So I went over a couple of the CLO lists, and I just grabbed a name off the list at random just to see what we were looking at. Because we should not just take the worst possible picture. That was what was presented by Viceroy. This is the Maxwell. The canals at Grand Park. Let's have a look. This is the walk-in. This is the foyer walking in. There's a unit. Well, I'd live there. Look at that. That looks nice. There's another unit with a kitchen. Again, I see no problem with that. It looks good. Here is sort of, I guess, a living room area with the TV embedded in here. Starting at floor plans, starting at 1260. And you have different floor plans. You have 1 bedroom, 2 bedroom, 3 bedroom, and different floor plans. That looks nice, right? I mean, I think that looks nice. Let's look at another one. This is the Eddy at Riverview Landing, which is your, there's a common area. There is the exterior part of the building. There's a nice pool in the back of it. Nice little walkway down in front. I mean, that looks nice. And if we go back here, just to look at the vehicles that are here, these are not run down, beaten down vehicles, so the tenant quality must be decent. There's a balcony. There's the view from one of the balconies, the walkway, again, the pool. That looks nice. Does that look like a building on fire? No, it doesn't. Let's look at another one. This is 30 Morningside, which is this building right here in New York. This is sort of, I think this is the one that they said that is in average plus or good quality, but it's got a gym in there. What else do we have? A conference or meeting. I think that's a conference room or meeting room. Different balconies on some of the units. That looks nice. Does that look like a rundown, beaten down unit? Doesn't look like a rundown, beaten down building to me. Let's look at another one. This is Wyndham Chase Apartments. This is, I think, in, where are we? St. Louis. So we're outside of the bigger markets. So it is what's called garden style apartment buildings. And this is the interior, you know, more working class. But it certainly doesn't look like what we saw before. But yeah, it is an older type building. But again, it is in Horizon Village Drive, St. Louis, Missouri. Let's look at another one here. This is Greenwood and Mackenzie, another garden style apartment building. You can see that it's older, it's dated, yeah. But the rents here are below market rents, and it is a transitional property where you would go in and you would upgrade the units and recycle the tenants. You got a pool area behind here. You have some amenities. You have nice landscaped grounds. Does that to you look like a slum that the title of that Viceroy report had? Okay, we're gonna just review one more thing before we start paragraph by paragraph with CFA Venger's report. This is, if you're on that landing page reading the report, if you look at the top, you'll see a second tab. The tab is for comments, and in the comments section somebody was questioning something, and as a reply the author posted this story, TREP article on multifamily bridge loans from 7/20/23. Let's just look at this for a second because it is just a general level of misunderstanding out there, even from the author of the article that CFA Venger is trying to put forth as defense. And there's a very egregious mistake done here. So let's just begin to read here. Multifamily syndicators come under scrutiny. Everything to know about exposure to CRE, CLOs, and floating rate debt. And as I said, there seems to be just a general misunderstanding when it comes to CLOs about statistics and what you're looking at. For context, the article starts, all CRE, CLO loans are floating rate loans, whereas, that sets up a contrast, CMBS has a mix of both fixed rate and floating rate loans. So number one, there's the first contrast the author is setting up. CLOs are floating rate, CMBS has some fixed rate. Number one, CRE CLOs are collateralized by bridge loans, characterized by having a short duration of 3 to 5 years on CRE properties that are undergoing a transitional strategy. On the other hand, CMBS are typically backed by loans on stabilized properties with longer duration of 5 to 10 years. Notice the second contrast. The first contrast is in the way they're financed. The second contrast is in what they actually are. These are mostly transitional. These are stabilized. Two contrasts. Next paragraph is attributing the difference between them entirely only to the first difference. Looking at the breakout by source of financing, the weighted average debt service coverage ratio, NCF, using the net cash flow, not net operating income, or what should properly be used, adjusted funds from operations. The weighted average debt service coverage ratio of 0.98 for the CRE CLO loans under these multifamily syndicators is significantly lower than the 1.7 for the CMBS loans, showcasing the current financing challenges for transitional projects. Dichotomy 1, dichotomy 2, but I'm going to blame the whole difference on dichotomy 1, and I'm just going to ignore that, wait a minute, these are transitional, these are fully stabilized. Well, of course you would expect to see a much better debt service coverage ratio on fully stabilized properties than on transitional properties. But this author of the TREP article on multifamily loans, you would assume that they know what they're doing here, is mixing a few things up. using NCF, which we've already seen accounts for way too much in terms of CapEx. So how can we have done this better? How can we compare the 0.98 with the 1.7? And if you have been through the CFA program, level 1 FRA, what do we learn to do? We learn to produce comparable numbers depending on the type of accounting policy that the firm had used, whether they're using IFRS, whether they're using GAAP, whether they're using LIFO or FIFO. We read the statement, we say, well, hang on now, these ratios are not comparable. We need to make adjustments. Well, you need to make adjustments from the 0.98 to compare it to the 1.7. And the adjustment must come in the fact that you're looking at transitional versus stabilized. So the first thing we should have done for the CLOs is use the stabilized debt service coverage ratio, not the as-is debt service coverage ratio. Next, we should adjust the net cash flow for the source of cash flow, especially the CapEx, the renos from cash. So remember, it starts with net operating income, and it subtracts from that CapEx, not just maintenance CapEx, but renovation CapEx. Now, maintenance CapEx, I can see. Your net operating income, you should adjust it for the maintenance CapEx because that is a keyword here, ongoing. But renovation CapEx, that's a one-time deal. That's actually a capital as opposed to an operation expense, a capital expense. And it's usually one time, and it usually comes from a cash account, not from the rent rolls. And for these loans, there are the capital spending reserves that are used to fund those. They're not coming from the rent roll. However, the NCF calculation just subtracts it from net operating income, so it's mixing sources of cash flow. So we should add back the one-time CapExes that are being done, the tenant improvements. Keep the maintenance CapEx, but add back the tenant improvements because they're only done once. They're not ongoing or recurring. So that should have been added back to net cash flow. So in other words, your numerator should have been higher. And since you're using a stabilized debt service coverage ratio, it would also be higher because it would reflect the higher rents that you expect to get with redeveloped properties and the higher occupancy that you would expect to get as well. And you should adjust the cash flow from the caps if the location of the cash flow was at the corporate level. What does this mean? Let's say that you have a corporation that has all of these properties and all of the loans are on these properties, but the cap is held up here, so the cash flow is coming into here. Well, it's not going to show up down here. So what is your interest expense going to be? It's going to be the full interest expense, but the cap cash flow may be offset at the corporate level, as opposed to each of the individual unit levels, right? It depends on where that cash flow comes. You're probably not going to get a lot of visibility on that. However, we should be aware that that is a possibility. Then we can begin to compare the 0.98 with the 1.7. If we look at the pre-sale report for Arbor 2021 FL1, here is the Morningstar as-is debt service coverage ratio, 0.98. Notice what happens when they stabilize it, 1.26. It increases from 0.98 up to 1.26. So we should have used, if you're going to compare it against stabilized properties, you better stabilize the debt service coverage ratio on here and not use the as-is. Do you get that? So the author of this focused on just, I want to tell a story about interest rates. These two things are different in interest rates. They're different on this as well, but I'm going to attribute everything to the interest rates and look at the difference between these debt service coverage ratios. So, in defense of CFA Venger, if he was or she was learning at the time and used this article as, okay, that's interesting information, then we could attribute the misunderstanding to the author of the article, which then perpetuated itself to CFA Venger, who probably should have just looked below the table of the exhibit he presented, or she presented early in the article, and read that, oh, hang on a second here, the debt service coverage ratio and the loan to value ratio are not based on what we would expect to see on the financial statements, but something else. Okay, we have a good solid foundation. I think we can run through the report rather quickly at this point. So what I've done is I've taken screenshots of what was written and what was presented, and then we're going to counter it. A rating agency pre-sale report from one of Arbor's 2021 bridge loan securitizations illustrates the aggressive assumptions. Careful with the hyperbolic language. Whenever you're reading short reports, I want you to cross out all of the adjectives, because the adjectives are opinion. They're not fact. It illustrates the assumptions. That's a true statement. Nobody could disagree with. But once you have the aggressive in there, whenever you're reading short reports, cross out all the insults and cross out all the adjectives, and then read. That's how you get to the underlying facts. It says, illustrates the assumptions underlying Arbor's lending practices. Loans were made at 83% loan to value. Where are we getting the 83% from? Here it is. This is the Morningstar as is issuance loan to value. Look at the note below, of which this author, CFA Venger, does not provide you. All debt service coverage ratios and loan to value ratios, all Morningstar calculations, are based on the stressed interest rate and the fully funded and extended mortgage loan commitment. The as is reported here at 77.3. Morningstar is at 83.4. The as is what is currently funded. The 83.4 assumes fully funded. It also, for the as is loan to value, again, as we see down here, it assumes a stressed interest rate, not the current interest rate. But this author decides to just jump to the 83 and saying, well, the difference between the 83 and the 77 must be the super aggressive assumptions that Arbor is making. But it is not the super aggressive assumptions. It is the super conservative numbers that Morningstar is using to calculate it by saying, I know you haven't lent them this much money, but we're going to go ahead and assume it. And I know they're not paying this high interest rate, but we're going to go ahead and put it in place and calculate a number ourselves. Well, that's not reality. Okay, there's a difference between Arbor making aggressive assumptions and somebody else making really conservative assumptions under a stressed scenario. Loans were made at 83% with the assumption that rent increases and capital investment could drive those loan to values towards 70%, where the loans could be financed by the GSE. And if we want to know, well, what does Morningstar think about this? We would look at the stabilized loan to value. There is Morningstar's stabilized loan to value under a stressed condition, 69.1. So yeah, Morningstar agrees with it too. What's going on? This is a stabilized, again, with these assumptions down here. The author does not include this nor adjusts for it. So right away we could say, hang on, you have a bit of a fault in your logic here. Okay, next to paragraph. Well, Arbor does not provide detailed visibility into its portfolio, and we do get some visibility into the part of the portfolio that has been offered as collateral that really isn't even on Arbor's balance sheet, collateral against the CLOs. TREP data shows the mean Arbor financed property was built around 67 and would be designated Class C multifamily. You need a data subscription for this, and it is pricey. Class C. Yeah, no one is disputing that. This is consistent with industry contacts which view Arbor as the Class C originator of multifamily loans to syndicators and small LLCs. I don't know why we need industry contacts to verify that. Arbor will tell you straight up that's what it does. Relative to Walker and Dunlop, which is considered an A-class originator to institutionally sponsored assets. Okay, what's the point of this paragraph? The point of this paragraph, at least from what I can tell, what the author is trying to do is trying to position Arbor as less than. But it would be like me saying, everyone agrees that this venture capital firm invests in early stage companies, contrary to Warren Buffett or Berkshire Hathaway, which invests in established companies with a long history of profitability. Yeah, that's the point. That's what venture capital does. To make the contrast between venture capital and Berkshire Hathaway, to me, is the same as making the contrast here from what Arbor does to Walker and Dunlop. Who cares what Walker and Dunlop do? That's what they do. That's the part of the market they play in. Arbor plays over here. It has a skill set in playing over here. Much like venture capital firms have a skill set in early stage businesses, which Berkshire may not have, right? So all this is saying is really nothing. It's like, yeah, but if you listen to Arbor's conference calls, they'll tell you that straight up. This is what we do. I don't know why you needed to go with industry contracts and to compare it with a Walker and Dunlop. It would be like, again, me comparing VC with Berkshire. This is what they look for. Average quality that has below market rents, that has lower occupancy and lower credit quality tenants. The business plan is renovations, tenant recycling, and lease up. Update, upgrade, stabilize. That's the business plan. Let's go to the next paragraph here. Arbor has two big problems. First, the rapid rise in rates post-pandemic puts upward pressure on the debt burden of these projects. Many had interest rate caps. We've already seen that. 70% have interest rate caps. Downward pressure on their valuations. Again, these are below market rents and buildings that were bought at a price that reflects what they're working on. That reflects the fact that they're transitional properties. Update, upgrade, stabilize. You can bring property values up even in a market where property values are flat or dropping because you started so much below the market. So I don't know if it puts downward pressure on their valuations. It certainly doesn't help. I'll grant that. It certainly doesn't help. It is a headwind. I'm not going to go too far on this one, but I am going to say, well, hang on a second. We are below market to begin with, right? But point made, it is a stressed environment that we're in. Second, rent growth in their key Sunbelt markets, the key Sunbelt markets. So whenever I see this key Sunbelt, well, is that true? So I went to look. 16% of multifamily loans are in Florida, 24% are in Texas. The rest are spread out over all the states. So, okay, for 40%. So, okay, I'll accept key Sunbelt markets, but with a little pinch of salt that it's 40%. Rent growth has stalled. Okay, rent growth has stalled. And here is, if we look at Miami Realtors, here is rent growth, and here's the 2021 to 2022 period where you had the rapid increase in rents over that period of time. And then they sort of just gone sideways. Some of them peaked and then have turned down. Many of them are down from their peak. And if you look at some of the counties, like Miami-Dade, like 8%, and different counties are down on the rent from their peak. But look at the word median multifamily asking rent, the median multifamily asking rent. If you're going to look at rents and look at the trend of rents, you must look at the quartiles, not the median. So you have to then break it preferably into deciles if you can, but if you can find some data that breaks it into quartiles, and I think you're going to have to go into government data to get that done, but that can break it into quartiles, then you would look at saying, well, chances are these properties being transitional were in the lower quartile. So what's going on with rents in the lower quartile? Because if you have rents that are dropping after a big surge up, it is typically the rents in the upper quartiles that would be under the most pressure because they would have advanced the most. So you can't look at the median without considering the distribution. I mean, we're finance people. We know that, right? If I say, which asset do you want? One with a 9% return or one with a 12% return? Your question would be, yeah, at what volatility, right? At what volatility? So that means that we want to know something about the distribution. Well, you can't just say rent growth has stalled. If you're looking at median rent, you're looking at the wrong thing. That is not reflective of where the arbor properties are. Let me give you an example of this. When we looked at wage growth, for example, and we said wages are growing at 5.6%. That is median wage growth. When you broke it down and you looked at less than high school and high school, they were growing much faster than BA was growing. So it's not 5.6% if you say, well, how are these low-income people going to continue to afford things? They're getting just a little bit more than the rate of inflation. But hang on, if you look at the employment data and you look at where the wage gains were coming from, and you can get this from the Atlanta Wage Growth Tracker, and you say, let me see less in high school, you will see that their wages grew much faster than high school, than some college and college. Well, that's important to know. You can't make a statement about the whole population with a median when there are different specific subgroups in the population. Using median rents is the wrong thing to use on this one. So I'd say I'm a little bit concerned about your statement saying rent growth is stalled, hence the portfolio is going to have a problem. Makes it unlikely many of these projects will reach anywhere near their stabilized projections. Look at the hyperbolic language, which makes it unlikely. I would take out the unlikely if I want to be serious, and I would say which challenges these projects in reaching their stabilized projections. Anywhere near. That is meant for you to make that distance really wide. Unlikely, many will reach anywhere near their stabilized projections. Do you see the writing? The person is writing hyperbolically in places. Now, when you go to Viceroy, you will find much more of that type of language. You need to rewrite that sentence so it's true, so that everyone can agree that it's true. Median rent growths in Sunbelt markets, and then maybe in brackets put Florida 16%, Texas 24%, if that's really the point that you're trying to make, has stalled, which makes it challenging for these projects to reach their stabilized projections. No one would disagree with that statement. If you really believed in what you were saying and you wanted the institutions with you, you have to make a statement that's true. No one will question that. But because I look at this and I'm starting to cross things out, I'm wondering, well, what's the motivation of the writer? I've already found a whole bunch of little issues and little mistakes that the author and shortcuts the author is taking, and we're going to find a lot more. That once you start bringing hyperbolic language into it, you will be ignored. All right. Each of these problems challenge Arbor's business model of getting these loans refinanced. Well, we can look at the surveillance reports and see how well they're doing on that, by the way. But in concert, they compound the issues because the gating factor to GSE takeout financing is debt service coverage ratio. Fannie and Freddie require 1.25, including principal amortization at minimum. These are interest-only CLOs. So they don't have a principal payment in there. So those debt service coverage ratios that Morningstar is calculating is interest only. He's got a point here. They do not cover the principal. What's going on? Is this it right here? 1.25 is what you're going to need at a minimum. Higher interest costs and lower than projected rents pressure both the numerator and the denominator. Well, that would be true. If that were the case, that would be true. But Fannie and Freddie, yes, they do require 1.25. But let me get some space here and let me see if I can make the point of what our analyst is missing on this one. How come this is not getting rid of here? I want to get rid of that. There we go. Oh, they're all on different layers. That's why. Bear with me. I'll get them all off the screen. There we go. Okay. So these loans that he's referring to are interest only loans, and they're based on SOFR 1 plus some spread, some particular spread. Fannie and Freddie, these will be 30-year, based on 30-year mortgages. Let's be conservative. Let's say that it won't be based on 30-year. Let's just get even more aggressive. So let's say it's going to be based on 10-year. Okay, it'll be based on a 10-year mortgage. Let's look at the yield curve. There are your money market rates, right? The current yield curve we have, and here is our long end of the curve. We know right now we have a 3-month to 10-year inversion that is greater than 100 basis points. SOFR here is sitting around 5.5. The spread is somewhere around 380 to 400 basis points on this one. The 10-year mortgage is around 7%, 7 to 8%. Let's just be aggressive, say 7 to 8%. 5.5 plus 3.8, you're anywhere from 9.3 to 9.5% on SOFR plus a spread versus the mortgage that would be in place if you moved to a GSE. Look at the difference in the interest rate. So even if you did include the principal at this point in time, the interest service would be much lower at that point in time. Also, in moving into here, it is very common that when you move a loan from the CLO to the GSE, that there is a capital call on the part of the borrowers where they put up a little bit more capital to improve the loan to value ratio on the way in, which lowers the amount of debt that they then have to roll over into the GSE. So not only is the interest rate lower with an inverted yield curve, right? With an inverted yield curve, the fixed rate will be lower than the floating rate. I am surprised that that was not picked up on. CMBS loans typically have 5, 7, 10-year terms and are partially amortizing or even interest-only loans. That is CMBS. In contrast, Fannie and Freddie both have fully amortizing 30-year loan options for multifamily properties. The 30-year fixed rate is lower than the floating rate plus the spread. It's lower. The 30-year fixed on multifamily is lower than that. That's not accounted for in this statement down here. So fully amortizing 30-year options for multifamily properties can be beneficial to borrowers since they won't have to refinance their loan or sell their property in order to avoid a large balloon payment at the end of their loan term. So for the borrower, sometimes it is beneficial to meet a capital call, a small capital call, to move into a GSE than to face a balloon payment at the end of a 3 or 4 year bridge loan term. So they are willing to come up with the extra capital to make the transition. And yes, we have an inverted yield curve. Moving from the floating to the fixed is actually a benefit at this point in time. Moving from the floating to the fixed. Isn't that beautiful? And where is that? Where is that stated? So we have a problem here is that we are trying to compare a strategy of one company to a strategy of another company and suggesting that Arbor is somewhat deficient because it's not as good as Walker and Dunlop. We have another problem here in that we are looking at median rent growths as opposed to looking at quartile rent growths and saying, clearly, if we have Class C properties, we're in the lower quartile. What's the rent growth in the lower quartile looking like? Maybe it's still strong and it's the upper quartiles that are weak. This is the median. You can't look at averages and make a statement about everybody in the population. Secondly, or last, we are saying these properties are in no way ready to get into a 1.25 interest and principal amortization. Well, the interest rate is significantly lower, and again, look at that amortization period. So no, it's not that big of a stretch, but all these things are missing from this statement. Now, it's sort of assuming Fannie and Freddie require this. It's not going to happen. Not all properties are bound for the GSE, right? Owners can sell for a capital gain and pay out the loan. Q1 of 2023, of all the loans that were paid off, only 50% went to the GSE. $1 billion in loans were taken down in the first quarter. Only $500 million went to the GSE. In the second quarter, only 65% of the loans that were run off went to the GSE. $435 million went to the GSE. Not all the loans have to go to the GSE. I can borrow, get a bridge loan, improve a property, sell it to another investor as an improved property, pay off the loan, and walk away with my capital gain, because that's what I do. I turn over these transitional properties. I'm not interested in holding it long-term and going to the GSE. Let somebody else do that. So not all the properties are headed to the GSE, and the GSE is going to have a lower financing rate for the owners of the property anyways. Okay, this is a paragraph that I was really disappointed in. I expected more from the writer. Look how it starts. Let's use an example to illustrate what this means. Now, what do you have in mind when you read that? Okay, we're going to make up an example. We're going to use an example. Great. Assume, now we're not saying notice from Schedule 3, Table 4. It says assume that projects financed in the 2021-2022 timeframe were purchased at a 4.5% as-is cap rate. Now, we're not getting that from anywhere. We're making an assumption, right? You get that. If the buyer paid $100, clearly no building was $100. This is an example, I get it. And borrowed at an 85% loan-to-value ratio, there is $85 of bridge loan debt. I'm with you so far. The 4.25 cap rate implies the project throws off $4.25 in annual net operating income. I'm with you so far on that. Current GSE multifamily rates run around a 200 basis point spread to the 10-year, which is what I explained on the previous screen. To the 10-year Treasury yield, or approximately 5.75% at the time that the author was doing this. The 3-year must have been sitting at 3.75. As mentioned, the most generous GSE financial programs require a 1.25 debt service coverage ratio. Therefore, before even considering principal amortization, because of course this is interest only, 4.25 million, suddenly he's gone from 100 to 100 million, but okay, 4.25 million in NOI could support $59 million in debt at 1.25 debt servicing ratio. Look at that last sentence. But remember, Arbor extended 85 in bridge financing. Whoa. I thought this was an example and we were assuming. Now Arbor did this? See how it ends? A little bit of psychology there, the recency effect. If I can have you walk away from this paragraph thinking, oh my God, Arbor's really messing up. Arbor did this. Arbor extended 85 in bridge financing, which is now $26 underwater, or 30% of the loan's principal balance. You're getting scared, aren't you? You want to sell your shares. You're saying, what is Arbor doing? Well, it says, let's use an example, assume, and then it ends by saying, Arbor did this. Arbor didn't do this. Starts as an example, the general, and concludes by saying Arbor did this, the specific. Arbor did not do this. Let's use the data that this author clearly would have had available to it, which is the March 31st, 2023 schedule for loans and investments from the 10Q. Here are your bridge loans over here. Here's the weighted average last dollar loan to value ratio, 76%. And down here, 76%. This was from December 31st, 2022. It's not 85%, it's 77%. And if we go to September 30th, where we don't have 13.3 billion, we have 12.8 billion, it's at 77%. It's not at 85%. Arbor did not do this. This was an example you told me. Now, we do have some problems here. You're using the current as-is NOI. Right? Purchased, you're saying up here, this is an as-is cap rate. But the GSE would be stabilized. you would have a stabilized NOI by the time you're ready for the GSE. Again, you can't take a company, a venture capital finance company, in the first month and say, it's cash flow negative, it's never going to make it. No, you're taking a stabilized, a transitional property, looking at the as in cap rate, because you're saying, let's say it was purchased. Well, when it was purchased, it was transitional. You can't use that 4.25 NOI because it's not stabilized. You first have to stabilize it. What else do you see as a problem? If you go back to June of last year, what problem? Actually, this was June of 2023. Sorry, not June of last year. June of 2023. What other problem do you see in this statement? 4.25. Let's start with the 4.25 million. You should be able to see it if you recall the last screen. If we say 4.25 as is cap rate, the financing charge in that would be the short-term rate plus the spread. Remember, when we go into the GSEs, it's a 30-year rate. We have an inverted yield curve. The 30-year rate will be lower than the current financing rate, but in no way did the author adjust this to reflect the fact that, wait a minute, that will be higher. That will actually be higher because the financing cost will be lower. You would have found that it would have supported more. Not only that, you should have used a stabilized NOI and not an as-is NOI. Do you see how laziness can get you into a trap of thinking they're never going to make it? The projected stabilized NOI should have been used. The proper ratios should have been used. You had the 76%. Why you decided to use 85 in your example and then attribute that to Arbor? If you were going to attribute it to Arbor, why didn't you start at 77% instead of 85%? And then why didn't you adjust the 4.25 for at least some stabilization and some change in the interest rate expense from a short-term floating rate with a spread to a longer-term fixed rate? Given an inverted yield curve, the fixed rate would have been lower than the floating rate plus the spread. I see 3 mistakes in your conclusion here. In the next paragraph, the author attempts to recover a little bit, saying, well, okay, in all fairness, what about the stabilized stuff, right? What about those rent increases and stabilized projections which would offset the rise in interest rates? I say change would to could, which could offset the rise in interest rates. Arbor finances its portfolio with a combination of CLO debt and repurchase facilities for the half of its portfolio and repurchase facilities, and for the half of its portfolio in CLOs, we have relatively up-to-date transparency via TREP into how things are going. We examined data through the first quarter of 2023 on 224 loans in Arbor CLOs with a total balance of 5.7 out of 8 billion of Arbor CLO finance bridge loans, full stop there. Let's say that I take your word for it. Okay, and in fact, you are looking at the 224 loans. I'm not going to question it if you have access to TREP. I don't. I can't verify your numbers, but let's say that you're looking at that. You are looking at the opposite of survivorship bias, right? Remember, if we're looking at an equity index, at any given time, what's in the index? Only the companies that have survived. And then we could look at the performance of the index over time, but the index does not account for all of the companies that were in the index years ago that simply failed and went away. It suffers from survivorship bias. Well, the CLOs suffer from the opposite of that. All the successful ones leave. Remember, in the index, all the unsuccessful ones leave and new ones come in. For a CLO, all the successful one leaves and new transitional properties come in. So at any given time, it's going to look like the average holdings in the CLO are not improving. That's because the good ones are leaving and the new ones coming in are average, are at the beginning of their period. So you cannot look at the CLO over a period of time and say, look, over 3 years, all these ratios didn't improve, without accounting for all of the successful ones that left. So what you have to do is say, there are 224 loans, great. How many loans graduated? If you have 300 loans that graduated, there are 554 loans. That's your sample. You have to look at the statistics of the 554, not the ones that are left, because you're going to suffer from the opposite of survivorship bias. Okay, so you examined 224 loans. And again, you get my point on this, right? These properties were generating $370 million annual net cash flow. NCF, not NOI, NCF. These are transitional properties. Well, what is net cash flow for transitional properties? The definition is down here. Net cash flow. The revenue earned by a property's ongoing operations, okay, less the expenses associated, and again, fully funded, with such operations, and the capital costs of tenant improvements, leasing commissions, and CapEx or reserves. And what that is saying is that you should have a certain amount of maintenance CapEx. But if you're under investing in maintenance CapEx, and you should be to boost your cash flow, what we're going to do is we're going to take your depreciation and assume that you spent that in net cash flow because you should be. So that's what it means, or reserves if you're not doing maintenance CapEx. Moreover, net cash flow is net operating income, NOI, less tenant improvements, less commissions, and CapEx. Okay, what is tenant improvements? The expense to physically improve the property or space, such as new improvements or remodeling, paid for by the borrower. Well, once you remodel a unit, you're done. That means next year you won't be remodeling that unit, or the year after, maybe not for another 8-9 years. So that type of CapEx ends. You typically would not include special project CapEx like that, but net cash flow does. CapEx is costs incurred to improve a property that will have a life of more than 1 year. If it's maintenance CapEx, yes, you should do it, because NOI minus your maintenance CapEx, you will get the funds from operations, which is where you want to be. But if you're then taking off your capital improvements, which are one-time improvements and not ongoing CapEx, maintenance CapEx is ongoing. You must finance that. But your capital improvements are one-time only. Well, that is reflected in net cash flow, but it should not. It should be added back. It should be added back. So it's saying it's generating $370 million in annual net cash flow. But keep in mind that net cash flow is with the tenant improvements. And it says here, typically paid by the borrower. However, net cash flow is taking it off of the ongoing operations. Income from ongoing operations, less all of that stuff. But it's coming from another account. It's typically coming from a capital improvement reserve or a cash-funded account, and not from operations, because it's a one-time investment that should not affect cash flow. So think about it in terms of cash flow from operations versus net cash flow. Cash flow from operations is what is the cash flow that I'm generating from operating this building? And then you'll have your one-time items below the line, much like a company reports operating income. And then we'll have all of those one-time adjustments before it gets to net income, right? It's the same thing. You have to look at the operating cash flow less the maintenance CapEx would bring you to funds from operations. This is net cash flow, which is a number lower. So you're already using a depressed number. These properties were generating $370 million in annual net cash flow. But again, the 224 loans you're using suffer from inverse survivorship bias. The successful ones are gone. Again, assuming a GSE, the 5.75% and the 1.25. Again, so if you're assuming 5.75 as a mortgage rate, then you're going to have to adjust this for the fact that the interest expense that you had, remember, it's a stressed interest rate. You have to adjust it for that because it's going to be lower. And again, ignoring the fact that GSEs consider principal amortization when calculating debt service coverage rate, $370 million would support refinance proceeds of 4.1, which leaves 1.5 billion whole for Arbor, or 36% of the principal. No. Remember, Arbor holds the equity position mostly, not all the debt. So if this were truly the case, which it is not, you're comparing apples and oranges, but if it was truly the case, then it is not. Arbor's position is only to the extent that it holds the equity, and only to the extent of the proceeds it has not yet received. Remember, it receives cash flow over a period of time. So it is receiving cash flows over a period of time from the CLO, then its expected exposure at any point in time is whatever it originally put up less all of the cash flow that it received. So not really. The collateral manager for the CLO provides surveillance reports. We're going to have a look at a surveillance report soon, and does provide net cash flow, not net operating income. So we do have to be aware that net cash flow is taking net operating income and subtracting all these tenant improvements that are one-time deals. All right, next paragraph here. While these numbers are large and they align with troubling qualitative evidence out of the multifamily sector, Nitya Capital appears to be Arbor's single largest CLO financed borrower. Again, we don't have transparency into the half of assets financed internally on repo lines. With $400 million of identified loans across 9 properties, in February, Nitya sent its investors a letter admitting that multifamily properties it purchased in 2021 lost 44% of their value. I don't know where you're getting the 44%, but let's read. When he gave a number, it was an example, and it wasn't 44%; it was 34%. So high interest rates spur Nitya to sell assets. Okay. Nitya Capital is looking to sell nearly 40% of its properties, has suspended at least some of its cash distributions as it grapples with higher debt payments. Well, this is not Arbor, this is Nitya. So the argument being made is, yeah, but they owe money to Arbor. This is not saying that they've defaulted on their debt. They're saying in this high interest rate environment, Nitya is looking to sell some properties. So it's looking to manage its way through this process, right? In February, Chief Executive outlined steps the Houston-based firm is taking to weather the storm caused by rapidly rising interest rates. It's a sobering case study of how the buy, fix, and flip investor mentality, so rampant in 2021, is starting to unravel at some properties. Now, this is the author of this article. This is the author's statement. So we have to then say, hang on a second, is that a true fact? Is starting to unravel at some properties? Yeah, okay, at some properties, sure. As capitalization rates have risen amid the market dislocation, a property that was purchased for $100 a year ago is now worth $66.10, essentially wiping out the entire equity on the project, he said in the letter. So he's just giving an example. A property that was purchased for $100 is now worth $66, essentially wiping out the equity. That is the borrower's equity. That is not Arbor's loan. That's the borrower's equity. It says essentially wiping out the entire equity on the project. It's not 44. If we're going to say that this is a true statement about their properties, it's not 44. It's 34. And I think that saying that $100 is worth 66, I think is just a broad example that he's giving. We're going to read a little bit more about Nitya here in a second. This is from Real Estate Alert, the source. And this statement here is based off of the same story. There was another story in a March 16th note. This is our author continuing on. Our CFA author continuing on. Barclays analyst Lee Overby commented that, and here's the comment. But this comment was based off of this story. It's not a different comment altogether. It's the continuation of the same story, sort of making it appear that there is more. Reportedly has $2 billion of senior debt on its 60 properties. As short-term interest rates have risen, it is paying $60 million more annually in interest costs compared to what it paid in 2021. The article highlighted a Jacksonville portfolio. This is our author now. This is not Lee Overby. He's done the article highlighted a Jacksonville portfolio which the firm bought in late 21, while the rents of the portfolio have gone up 22%. Under its ownership, the portfolio is cash flow negative due to rising interest rate costs, and the firm is covering the shortfall. Okay, Firm's covering the shortfall. Again, this wouldn't affect Arbor if the firm is covering the shortfall. That is good. Now this was in February. Where are they now? They said that they were going to take some proactive steps to weather the storm. And we are saying up here, well, they're Arbor's largest CLO finance borrower. Well, let's see how they've done. Let's look at the news now and see where they are. Okay, this one's from November 15th. Ernst & Young announces Swapnil Agrawal of Nitya Capital as Entrepreneur of the Year for 2023. I just find that interesting that if he's doing that badly, that an accounting firm known for auditing, I don't think would put him up as Entrepreneur of the Year. But let's look at what's going on. Nitya Capital exits 3 assets in Texas, delivering strong returns, and goes on to outline what they've done here. This is November 2nd, 2023. So they're exiting their portfolios, and I think they walked away here boasting an average IRR over 25% across 77 sales. With these recent exits, we maintain an impeccable record of 77-0, boasting an average IRR of over 25% across these sales. So this sounds like somebody that can execute. It sounds like somebody that recognized early in February that they had to do something, and they are selling properties and successfully selling properties. The last update I saw was that they had successfully closed, I think, something like over 30% of the portfolio they started the year with. So they've done it. Okay, he's going to give another example, Houston Apple's Way portfolio. And this is something that Ninja Research jumped on as well, as saying that it was a big fraudulent deal. And this was actually addressed in the Q1 conference call. It was actually addressed. I don't know why our author here, who had access to the conference calls, I don't know why our author here did not pay attention to what was said on the call. Houston Apple's Way portfolio, which Arbor foreclosed on, which they did. They offered no workout and no modification on the loan. They simply foreclosed on it. And it's mostly because of this over here. Investors want $12.4 million back from Apple's Way. What happened was the key person here, Jay, was redirecting money. The allegation that he raised money from investors and directed it to other uses, not for the use that he had originally raised the money for. This was a bad actor. So when you see Arbor foreclosing on something, you have to say, well, hang on, you have a whole bunch of things available to you. You have workouts, modifications, recaps, all sorts of things. If it's bad management, then it's just time to go. And look at this. That's risk management on Arbor's part, I think, is that this was a bad actor. And yeah, let's just foreclose on the thing and get rid of this guy. And we'll see what they did down here. In the first quarter, according to The Real Deal, Arbor placed a credit bid on its own portfolio well below the principal amount due and won the bid as no other potential buyers emerged. Well, that's what you would do. First of all, you'd like out of the deal. So if somebody comes along and buys the property and pays out the loan, great, thank you. If nobody does, you can place a credit bid. A credit bid requires no cash. You can bid on the properties without cash. The debt that you owe on the properties acts as collateral against the purchase. And why would you bid? Why would you need to bid higher than you necessarily have to get it, right? No other potential buyers emerged. So when you do a credit bid, you have to be strategic. Let's say there's a property, and on this property, it was $217 million over here. So let's say that it was $217.4 million is what you have to recover, and nobody is bidding on it. Well, you can bid $217.4 million if you want, but if nobody's bidding to take it out, then you're pretty much going to have it. You may argue that, you know what, we're willing to lose 5% on the deal. We're willing to lose 5%. If we can get out at a 5% loss, that's fine. So maybe you put in a bid at 95% of what's owed, and you say, we'll offer $205 million. Now that that's the bid, you're thinking maybe somebody will step in and better that bid and we'll lose less than $5 million on the loan. We're willing to take the loan loss on it to get out of this one. Sometimes you're willing to take a loss to get out of something. So you'll put a bid on and you're hoping that it'll just get beat. Like, you're not going to say, well, why not just offer $1 if nobody bid? Because somebody can offer $2. That's why you wouldn't just offer $1. Why not offer 217.4? Because then you are going to take it. Period. If nobody was bidding on it then no one's going to bid. If you're saying, well, we don't mind getting out with a 5% loss, then you'd bid 205. Then somebody else can come along and say, okay, well, we'll bid more than 205, and you'll take a loss on your loan. And maybe Arbor was willing to take a 5% loss. Well, nobody bid at 205. That's what they put their bid in at 205, and they got it. These 1970, it says well below the amount due, no other potential buyers. These were 1970s era Class C properties, which appears fairly representative of the overall portfolio. Yeah, that Arbor will be the first to tell you that's exactly what it does. So pointing it out is like saying these VC firms are investing in emerging companies. Yeah. Property was ultimately sold for $196 million. Or 13% discount to Arbor's loan value. That is a questionable number there. I could not verify that number. Did Arbor recognize the default and subsequent foreclosure as a credit loss? No. Rather, Arbor provided 100% loan-to-value financing to a new buyer to make the sale happen. It's not a new buyer, as the properties were in a tragic state of disrepair. They were in a state of disrepair, not tragic. Come on, you don't know that it was in a tragic state of disrepair. You want to say things that are true, right? I mean, maybe it was a tragic state of disrepair, but if you can't verify that that was the case, you could say they were in an assumed state of disrepair, a potential state of disrepair. No one's going to argue with you if they're Class C properties. And in need of massive capital investment. In need of capital investment. Come on. Once you start writing hyperbolic, you will lose the institutional crowd. In other words, the mid-teen percentage write-off is probably understated as Arbor moved from what was allegedly an 85%. You love this 85%. You love this 85%. I don't know where you're getting the 85 from. I can't verify that, so I don't know that that's true. But you keep coming back to this 85. Even though earlier I showed you that it was 76%, but you still wanted to stick to the 85. It was allegedly 85 to 100% loan to value. Q1 conference call said specifically there's a lot of misinformation about the transaction, and he says, I find it odd that the short report that was out specifically decided to pick on this transaction when it was a successful transition, one of the more successful ones they had done. So he found it really odd that they would pick on this. It was recapped and restructured. Recapped means that the person coming in is going to put in some equity as well. Recapped and restructured, the appropriate guarantees were put in place as well, which put the loan in a more favorable position than what originally was. The new buyer assumed the original debt and made a CapEx commitment. In April 2023, this is a subsequent event because we're looking at the March 31 quarter end subsequent event. We exercised our right to foreclose on a group of properties in Houston, Texas that are the underlying collateral for 4 bridge loans with an unpaid principal balance of $217.4 million as of March 31st. We simultaneously sold these properties to a significant equity investor in the original bridge loans. So it wasn't a new investor. It was a group of investors in this loan, but you had to get rid of this guy. You had to get rid of this guy. So you had to foreclose. You couldn't leave this guy as part of the deal. You had to foreclose and go back to the original, the people in the original loan and say, okay, let's do business with you. In the original loan, and provided new bridge loan financing as part of the sale. The new bridge loan financing would just be the assumption of the original bridge loan. We did not record a loss on the original bridge loans, and recovered all the outstanding interest owed to us as part of this restructuring. Recovered all the interest owed. If you recover all the interest owed, that loan is no longer in default. You have a significant equity investor, which has a recapitalization, has put appropriate guarantees in place, and has a CapEx commitment. And you got to get all of this past the auditor. So if there was no loss recorded on it, you can't just automatically go ahead and do this. You're going to have to get it past your auditor. Now, the quarterlies are not audited, but the year end is. And this is stated in their quarterlies. You're going to have to get that past the auditor. If at the end of the year you did something wrong, you risk the auditor reversing all that, and that's going to be highly damaging. Arbor has no track record of behaving that way in their accounting on any of their statements. If you look back through their history, they have no history of fourth quarter adjustments by the auditor. So you got to get past an auditor. There wasn't enough transparency on this to make some of the conclusions that this author is making, and some of these conclusions are based off of that Ninja research report, which was pure fabrication. So a bit of a problem here, and the problem here was you had a bad actor, and you had to get rid of the bad actor. All right, rent growth is not coming to the rescue, but does not give the time frame. You mean in the next 12 months, the next 18, next 24? Multifamily rents are no longer spiking as was seen in the 2021 period. Well, they're no longer spiking, but that doesn't mean they're not going up. Nationwide, effective asking rents on new apartment leases only increased by 0.3. Again, median. He provides this chart over here from Realtor.com. Median rent, median year over year. And this is market rents, the median market rent. We know that the properties we're dealing with here are below market, which is well below the rate of cost inflation for landlords, and marked the 15th consecutive month of slowing rental growth. Even the Sunbelt markets, which saw the frothiest increase in housing prices, are seeing weakness amid demand destruction and near record deliveries of new multifamily supply. I can't verify that there is near record deliveries under construction. Multifamily under construction is near a record, is at all-time highs under construction, but I haven't seen much in deliveries. But to say that that new supply isn't coming on the market would be false. New supply is coming on the market. It is a problem. And when that new supply comes on the market, they're usually offering concessions for rent, which is a problem because you got to compete with those concessions. You know, move in now, get 1 month free. And there's only so many tenants, so you have to compete for those tenants by offering your own concessions as well. So yes, new supply is coming on the market. I don't know if I go so far as to say that it is a near record high, but new supply is coming on the market in some of their markets. Not in all of their markets, but in some of their markets, yes. So I'll give that one. Even Sunbelt markets, demand destruction. Okay, so we've already seen this one. We know that it's median. There was the run-up in rents, and here we are since 2022, pretty much going sideways. But again, it's the median. This is median over here. So let's say that this is above market rents, this is below market rents. There's your median, right in the middle. That's what these things are capturing, is the middle. In every market, you're going to have some units that have above market rents, and the market is the median, that are going to have above market rents, and those that have below market rents. Typically, your Class A will be above market. Here, you would expect NOI growth to be flat to negative because they were the ones that probably had the most run-up. Median, that is what we call market rents. When we talk market rents, you're talking about the median, not above market. NOI growth, as we're seeing here, is flat, 0.3, let's call it flat. That's for Class A, Class B, even Class B a little bit below market. But when you get to Class C, you're way down here at below market rates, where NOI growth is flat to positive, and more so for capital improvement. That you can still, if you say rent growth is flat, if you can bring a Class C to a Class B, then you can bring your rents up from a flat growth rate at Class C to a flat growth rate at Class B. Right? You're not waiting for market rents and supply and demand in the market to improve your rent. Your business plan, your capital improvements are what are improving your rent. Now, it would be better if rents were increasing. Yes, it would. It would be better because that business plan would be a home run hit. It would be much easier if interest rates were low and rents were increasing. Then yeah, it's the easiest game in town to play. But in the environment that we're in, you need good execution. And it's not as if you're not going to get any rent increase. You will. It just won't be as great as you had before. But you're still going to get it. So let's just keep in mind that we are dealing with properties that are below market rents. These charts over here are market rents, in other words, being median rents. To do this right, we would have to look at rent by class or rent by quartile, because we're probably in the bottom 25%. Is the pattern of rent growth there different than for Class A or Class B? All right, this is a troubling paragraph, and we got to break it down into 2 or 3 sections. So let's just do the first couple of sentences here. Can Arbor just extend and pretend? I don't know what the author is trying to say. Arbor is not extending and pretending. One loan, the Apple's Way loan, one loan, and now you're suggesting that Arbor extends and pretends. It's one loan. Extend and pretend on these loans until rent inflation bails them out. No, it's not rent inflation that they're waiting for. It's capital improvement. And they're not extending and pretending. It was one loan. You're starting to become hyperbolic. It's assuming that this is the strategy on all the loans. It's not. In fact, in the first 9 months, 684 of the loans matured, paid themselves off, and went on. 435 went on to agency, which you'll recall this guy telling us how difficult it would be to get that done. The answer to that is no as well. Again, setting up a statement to get you to buy into they extend and pretend. Can they do this? No. Arbor's bridge loans, which are their assets, along with their liabilities, are variable rate. True statement. And have a current yield of around 8.5. Which ones? You're saying their bridge loans and their liabilities are variable rate and have a yield of 8.5. The assets or the liabilities? So I thought, well, let's go find out. Maybe he just meant the liabilities. And to match the timing of our author, I'm going to use the Q1 2023, and we'll compare that with Q3 2023, and we'll look at all of the debt. We have the credit and repo facilities on note 9, page 20. That which is being used for the structured side and that for the agency side. As of Q1 2023, 3.28 billion in credit and repo facilities, a yield of 7.18 that they're paying, not 8.5. 6.17 on the agency repos. Not 6.7. Weighted average is 7.06 on 3.65. That is not 8.5. If we go to September 30th, we went from 3.28 down to 3.037. Paid down some of it at a higher, even though we have a higher rate, we have less of a principal. 7.7 is not 8.5, and he wouldn't have had this information. Agency, 3.54 instead of 4.22 on the repos at 6.69, higher rate. Higher blended rate, 7.59 versus 7.06, but on $250 million less. So they're managing their balance sheet in the right direction. As interest rates are going up, they're managing their liabilities down. However, because you're saying 8.5, so far I've not found the 8.5. Let's look at the CLO. CLOs 14 through 19. Total 7.886 billion and had a weighted average yield of 6.11, not 8.5. What about the senior unsecured? Had a balance of 1.423 at 5.42, not 8.5. Now you can go to Arbor's Q1 2023 statement and find the schedule and verify that these are the numbers yourself. And this over here, the 611, this is non-recourse, non-mark-to-market because it's consolidated. It's not Arbor's debt. it's the variable interest entity's debt. It's the CLO's debt. Arbor makes a point of saying that they are issuing their CLOs issued at yields lower than where the market is. That means that other CLOs doing what they're doing, because they don't have the sponsor strength, actually have a higher rate. Remember, the pre-sale report showed one of the pluses, one of the strengths of this deal was the sponsor strength. And they do tout that on their earnings call, that because of their relationships and their strength and their performance over the years, they can get their CLOs out at yields lower than market. Assets are yielding 8.6. I don't see 8.5 anywhere. It would seem like you could just look on the statements and get the right number, but you're stuck with the 8 and the 5. 85% loan to value when it wasn't, 8.5% interest rate when it's not. Going to 2023. CLOs went from 7.8 down to 7 billion at a higher rate. 7.09 is the rate, because these are floating rate. Paying 7.09. Again, they make the point that that is below market, that the yields they're paying are below market. Yes, it is a higher interest rate by almost 100 basis points, but you have almost $850 billion lower. Senior unsecured, 5.41 was 5.42, and it's down 53 million. Assets, 8.8%, no 8.5. I don't find 8.5 anywhere. Current yield of 8.5, and is sort of conflating. The assets and liabilities have a yield of 8.5. No, they don't. Just servicing the interest on 5.7 billion of borrowing would cost 485 million a year. That's at 8.5%. I've just shown you there is no 8.5%. If you want to get aggressive, you would weight all of these by the value, come up with an amount, and even though this is just, remember now, this is just the CLO amount of the loans that he surveyed, you'd actually just use 6.11. But if you want to get aggressive, use all of the debt. But at 6.11, that's much lower than 8.5. Would cost 485 million a year versus 370 million of property net cash flow. Again, you're using net cash flow. You're using 8.5 interest rate. There is no 8.5. It's 6.11. You're using 370 million, but that's not funds from operations. That's net cash flow, and that's a stressed number. Do you see how many mistakes there are? When you have big numbers, $1 billion, if you have a rounding error in your interest rate, 1.63 versus 1.65, it's a lot of money. Well, what if you have a rounding error from 6.11 to 8.5? That's not a rounding error, that's sloppiness. So we can just ignore that. Okay, let's keep going here. Much of Arbor's borrower base purchased rate caps. It just says much of Arbor's borrowers base purchase rate caps for protection. A little bit of research, they tell you specifically 70%. I don't know why you wouldn't just include the actual number. For protection against rising rates, but they have runoff or will do so soon. Where are you getting that information that they have runoff or will do so soon? I've listened to all the conference calls, and on every conference call there's been a discussion of the caps. And none of that has really come up. What has come up is an issue about renewing the caps, and the CEO says, look, caps are about 3 points. It costs about 3 points to put a cap on, so if you want to cap your interest rate at 3%, all in you're paying 6% because the cap's going to cost you 3 points. So at these rates, it doesn't make sense to purchase any more caps. But that doesn't mean that the caps have run off. 70% of these loans required the cap, and most of them are 3-year loans. Right? Let's see. Arbor holds 7.2 billion multifamily bridge loans originated in 2021, and 4.8 billion originated in 2022. Arbor's bridge loans mature in 2.5 years at origination. They're 3-year loans. For the most part. They do make some 2-year loans, but only if the building that they're financing, the project that they're financing, does not require a long-term turnaround to get it stabilized. But they do make a point that the majority of their loans are 3 years. as of the first quarter, the weighted average remaining months to maturity on their portfolio was 18 months. As of the first quarter of 2023, you can look at note 3, page 9, Q1 2023. The average maturity was in 18 months. From Q1 of 2023, the average was 18 months. That would put it mid-2024. Remaining months to maturity of their portfolio was 18 months. This means the 2021 vintage loans are beginning to mature and will do so at scale over the course of 2023. What you're doing is you're taking 2021 and adding the 18 months that was in 2023 and getting to mid-2023. You can't do that. They are mostly 3-year loans, so this is 2024. That's 2024, not 2023, 2024. And if you are saying, the average is 18 months, if you're getting that number from Q1 of 2023, you must put the middle of the distribution somewhere in mid-2024. It's just sloppy work here. This means the 2021 vintage loans are beginning to mature, will do so at scale over 2023. Well, that is just not true. And again, let me point out that an inverted yield curve exists in this environment. So there is a lower 10-year treasury rate, as the 10-year goes lower, borrowers begin to move to fixed. And on their conference calls, they already noted that every time the 10-year treasury drops, every time there is a bull flattening of the long end of the curve, they are noticing that some of their borrowers are taking the opportunity to slide into a fixed rate. Which means getting ready for the GSE, which requires a few things: a recapitalization with a capital call and some mezzanine financing. So what that means is that the investors in the building will put in more cash, and that lowers the loan to value ratio, which lowers the face value of the loan that you need. And sometimes Arbor will step in with mezzanine financing that is also considered equity. To get that to happen. And that would, because we have the inverted yield curve, give them a lower financing cost. In Q1, how did they do on the mezzanine? They put up $5 million of mezzanine to send $500 million to agency. So of the loans that they were able to move to agency mortgages in Q1, they posted $5 million in mezzanine financing for that. In Q2, for the $435 million, they posted $1.5 million in mezzanine for that. And if you look at their balance sheet and you look at the level of mezzanine debt they're holding, it's not a lot. But if it gets them over to the GSE, why not help them out? So basically, the capital structure you have over at GSE is the borrower's equity, which was increased because of the capital calls. You have some mezzanine finance if necessary. And then you have your mortgage at 70% loan to value, which is the cutoff that you need, or even lower depending on the capital call. Because the owners of the building, the borrowers of the bridge loan, have a choice. Listen, in 11 months, this bridge loan will mature and we'll have to refinance. We don't know what that looks like. However, listen guys, if we all just put in a little bit more money now, we can avoid that. Because we're going to have to put in a lot of money in a year, or we could put a little money now and move over to the GSE. And listen, Ivan's willing to give us a mezzanine debt for a couple of million if it'll help us out. You're more willing to make a capital call at that point. And in the conference call, he said that's what's happening. As the 10-year, and in the third quarter conference call, he says under 4.25 on the 10-year, because he already knows, based on the clientele he has. Under 4.25, he says, you'll see that pick up. Under 4%, you'll see it explode. Okay, so what we're looking at now is the long end of the curve. Well, yeah, third quarter, September, October was ugly because you had a bear steepener. Well, the 10-year is down some, 60 basis points from that, from its peak. And there is a belief that the Fed is done. That's a sort of mainstream at this point in time. So if the 10-year continues to move down, a lot of the portfolio investors in the properties themselves will recapitalize and move over to GSC. Because you have an inverted yield curve, the fixed rate will be lower than the floating rate. For those that are left, here is the SOFR 1-month forward curve right here, and here is December 2024, a SOFR sitting at 4.39, or at least the forward rate is at 4.39. December 5.35, that's a drop of 96 basis points. So if you believe that the floating rate is going to drop, why would you spend money on rolling over your caps? Why not just take the drop in rates? So as long as inflation keeps coming down, if the market believes that is the case, and that does happen and it does unfold, and the Fed begins to cut rates in the second half of 2024, if it's consistent with the SOFR curve, you would get 100 basis points worth of cuts. So why would you spend more money on caps? Okay, let's finish up with that paragraph. As the corresponding interest rate caps expire, many of these projects will not be able to maintain debt payments to Arbor in an extension scenario. Where's your evidence of that? There is no evidence that that is going on other than here or there, other than in a few loans. But that's going on with every bank. That's going on with JP Morgan, Wells Fargo. In this interest rate environment, yeah, you're going to have some loans that are challenged. But this is saying that they're not going to be able to maintain debt payments to Arbor. Many will not be able. Many, to me, sounds like more than just a few, and it's been a handful. Much less meet strict debt service coverage requirements to obtain the requisite amount of takeout financing without significant external assistance. And by this, we mean capital calls, and we're seeing that that is happening. Arbor reports that that's happening. Furthermore, extensions would require Arbor to obtain new property value assessments to maintain compliance with its own contractual obligations to CLO bondholders and repo lenders. These appraisals, as a rule, will come in lower than where the lending facilities contemplate due to higher cap rates, lower rents, and the mere fact. I love that word, mere fact, as if it's just a mere fact that the need for an extension demonstrates the project did not meet its business plan. I don't know that I would say that that is a mere fact. Where is your evidence of this? That they'll come in lower due to higher cap rates. Yes, they would come in lower due to higher cap rates, but over a period of time, if you look at a time frame and you say, okay, well, if you need an extension, you're at the end of your 3 years. If you look at what they've been able to do with the renovations and the rent, they've been increasing their rents. So even if you lowered the cap rate, there's no evidence that that would result in a lower value for the building. Where's your evidence of that? You can't just say cap rates would change and that would affect property value unless you make the assumption that net operating income isn't changing at all. Well, maybe it is. It's supposed to. Over time, it does, right? So we'll look at some surveillance reports and we'll see how much this has actually been going on. Lower rents. So we've already made the point. We have lower growth rates, not lower rents. And since we have median growth rates that are flat and we have below market rents on Class C and we're trying to upgrade these to Class B, even if Class B rents are flat, just moving from C to B is an increase. I've already said that. A mere fact, a need for extension demonstrates the project did not meet its business plan. To determine whether or not these business plans are working, you have to look at all of the loans given, how many needed an extension versus how many did not need an extension. The surveillance report tells us of the pool of loans how many needed an extension. So we're going to look at the surveillance report for the 2021 because our author here seems to be excited about 2021. This is from a year-end 2022, an update from the collateral manager. I just grabbed one at random because there are these reports about each of the properties in there, and I just grabbed one. According to the year-end 2022 update from the collateral manager, prior to the loan modification, now as of March 31st, the author of this would have had this information available to him, would have been able to read these things. Prior to the loan modification, the lender had advanced $1.8 million of the renovation reserve for the renovation of 92 units, building improvements, and the remediation of deferred maintenance. Portfolio occupancy rate and average rental rate were 92.6 and 14.47 as of April 2023. Okay, 92% occupancy, 14.47 as of April 23, compared with 79% and 13.66 at issuance. So this was issued in 2021, and it is at the end of 2022, and it's gone from 79 to 92. Rents have gone from 13.6 to 14.47. 7 of the 8 properties are subject to rent stabilization laws and are fully rent stabilized, so there's probably no upside. The property lags the market in terms of rental rates and occupancy. According to Reese data, as of Q1 2023, the average, and we got to be careful about the average, the asking rental rate was $29.11. So there's the market. We're way below market. But notice that that is the basic profile of these properties is you're going to have rents below market. And even if market rates, even if this rate of $29.11 was $4,000 and is down 25%, we're so far below market that just the renovations, right, improvements, remediation of deferred maintenance, was able to increase the rent. So the idea that these apartments are not going to be able to raise rents because median rents are under pressure, these are not median rents. You could have read this, right? Property lags the market, 9/11, well, the average vacancy rate was 3%. So we have a vacancy rate of over 7% versus 3% for the market, 14.77 versus 29.11. This for this property here on the surveillance report, March 31st, 2023, net cash flow is 1.1 million. This is just for the 3 months, so it's 4.4 million for the year, 1.1 million. And the property got an updated appraisal of 80 million in February of 2023. In-place loan to value of 71.3 based on the whole loan, not the as issued part, but based on the whole loan. So over that period of time, they achieved higher occupancy, higher rents. Yes, below market rents, but when you start from below market rents, moving up to market rents, even if market rents are moving down, see what I'm saying? Let's have a look at this surveillance report, and we'll look at loan extensions versus non-extensions. Okay, these are, I think, every 6 months. This one is June 2023. You can see the date over here. The previous, I think, would have been November, and we won't get another one till November, which we're in the month of November now, but I haven't seen the new one yet. So let's just read the, we're not going to read a lot. We don't have to read much. Transaction closed in March 2021. Initial collateral pool consisting of 37 floating rate mortgages and senior participations secured by 64 mostly transitional properties totaling 635 million. Most of the loans were secured by cash flowing assets with some level of stabilization remaining. The transaction included a 180-day ramp-up acquisition period, which was completed in July of 2021, when the cumulative loan balance was 785. The transaction includes a 30-month reinvestment period ending with the September 2023 payment date. So this will not be a fixed portfolio. Well, as of September 30th, right now we're in November of 2023. As of September 30th, just 2 months ago, it became a fixed portfolio. At the time the author was writing his report, this was not a fixed portfolio and should have been aware that you cannot just take the statistics of the portfolio and say these are almost due and the statistics suck, because we'll look at how many loans matured from this. Not matured, but paid out. Let's see. During this period, reinvested principal proceeds are subject to eligibility criteria, which includes a rating agency no downgrade confirmation by Morningstar for all new mortgage assets and funded companion participations exceeding $1 million, among others. So this is saying you want to put a loan in here, you got to make sure that Morningstar clears it. And if Morningstar doesn't, the collateral manager can't put it in. That's one of the eligibility criteria. Since the last rating action, which would have been November, 2 loans with a cumulative balance of $75 million have been added to the trust. As of May 2023 reporting, the principal collection account had a balance of $110.5 million available to the collateral manager to purchase additional loan interests into the transaction. As of the April 2023 remittance report, the transaction consists of 36 loans with a cumulative balance of $674, 6 of which were in the pool at issuance. And this was initially 37 mortgages, 64 properties, and it's saying the number of loans, only 6 of the 37 are the original loans. That means 31 have been paid off. Since issuance, 44 loans with a cumulative trust balance of $673 million have been repaid, including 13 loans totaling roughly $250 million since the previous Morningstar rating action in November of 2022. So another 13 loans going into from November of 2022 to April, when this was done, of 2023. Let's just scroll down here a bit. We're looking for this here: current loan status, delinquent, none of the loans; specially serviced, none of the loans; modified or forborne, 7, 15.9%. And Arbor does make a point of this. We heard this on the third quarter conference call, that roughly about 15% of the existing loans need some kind of modification. But a modification is anything where you touch the loan. Okay, it could be a matter of you're done with the capital improvements and you have $220,000 left in your capital reserve account. Let's move that capital reserve account over to your debt servicing account. That's a modification. Okay, so let's read. There are no loans on the servicer's watch list or in special servicing as of the May 23 remittance. Additionally, no loans have received a forbearance. However, 7 loans, representing 15.6% of the current cumulative trust loan balance, have been modified. Loan modification terms have included maturity extensions and the transfer of funds from one reserve to replenish debt service reserves. So there have been some maturity extensions, but again, you have to look at how many loans there were versus how many were extended. There were 37 original loans in here. We have the information in the first paragraph. There were 37 that it started with, and more were added, and 44 were repaid, which includes these 13 loans just from the last time. 44 were repaid. Isn't that incredible? Let's have a look at the, if you keep going down. This is what I read to you. Manhattan Village gives you an idea. It takes some of them and gives you a sort of an update on a small sample. Next one is Laura at Friendswood. What do we have here? The lender had advanced $10,433 of the renovation reserve, leaving $763 outstanding. Collateral manager reported that as of February 2023, property was 91% occupied, average rent of $1,680. In comparison, the portfolio was 67% occupied in April of 2022. This is February of 2023, 67 to 91, right? So you got to pay attention to this. This is all available. Here's another one, Sterling Point. Now, they're not all great. Yeah, sometimes you'll find one where you go, that doesn't look good. But you got to read them all. You can't just pick one and put that up and say, look, here we are. Yes, it's a challenging environment that you're going to find there's a loan that's challenged. Duh. But it's the portfolio that we're concerned about. Look at this. This is a full loan payoffs since issuance. And this column here, loan purchased by issuer, did it have to be purchased by issuer? You'd see a Y in here if it was. Do you see any loans being purchased by issuers? And this is the repayment date. Okay, so 2021, let's ignore those because that was a good environment. 2022, interest rates started rising, but let's go ahead and ignore all of 2022. 2023, look how many were exited in 2023, and of course we had elevated interest rates. 1, 2 in January, 1 in February, 1, 2 in March, 1, 2, 3, 4. What do we got? 4 in April, 2 more in May. And that was the end of the report period, so we don't have anything further past May. Full loan payoff since issuance. Looks like it's being executed just well. Loan purchased by issuer. Nope. There you go. Okay, let's look at the most recent surveillance reports for a whole bunch of these, all the ones in 2021, FL1, FL2, FL3, and FL4. June 9th, 2023. We just saw this one, 7 for 15.9%. August 10th, 2023 for FL2, only 4, 19.6%. Again, modified or foreborn, but look at delinquent, look at specially serviced, nothing there, right? For 2021 FL3, this is July 2022, we have nothing. However, we will look at a press release for the September 1st report. I can't find the PDF anywhere, and it's behind a firewall, but we do have the press release. And this is FL4 for June 30th, 2023. Yeah, we do have a problem in there, 8.3% of the pool. Modified 10, which is about 14.1. So you can see 15, 9, 19, 14. It's running around 15%. But yeah, you're going to have loans that are delinquent. But again, think of the sheer volume of loans that they're making, and this is the numbers that you're getting. To not have any would seem that they are far too conservative in their business model. So you're going to have this. All the banks have this as well. So yeah. So if these are the numbers, and Arbor at one point was a $20 stock, maybe it shouldn't be a $20 stock, right? It is a $12 and I'll call it $12.50 now. So, I mean, it is down considerably. It's priced in, this kind of stuff. This is expected. This is already priced in. This is not, in my opinion, a short candidate. If this were 12, if this were 7, if this were 19, then I'd say, whoa, we got a problem. Let's look at the press release from this one. Okay, here is the press release. If you are searching for a surveillance report and you can't find it, oftentimes if you click on the Morningstar link for the surveillance report, you'll see that it's locked. But right below it, you'll see a link to the press release, and if you click that, you'll get the press release. So we can read the press release. The rating confirmations reflect the overall stable performance of the transaction, which has remained in line with Morningstar expectations since issuance, as the trust continues to be solely secured by multifamily collateral. We don't need to read this. It was initial 36 loans in there. Secured by 50 mostly transitional properties. As of August 2023, it comprises 49 loans secured by 67 properties. It had an 18-month ramp up and a turnover period, and I think the expiration for the capital recycling is in 2024. Since issuance, 26 loans have been successfully repaid from the pool. Remember, there were 36 to begin with. 26 have been repaid from the pool. 16 loans since the previous rating 6 months ago in November. 13 loans have been added to the trust. Now, these 13 would be at the beginning of their transitional period. A lot of them have already graduated. So when you look at the pool, it'll always look like they're all near the beginning. It'll look like they're far away from the qualities that they need because the graduates are gone. That is not accounted for. Let's just go down to, here we are, August 2023. No loans are specially serviced or watch list. 2 loans representing 56 million or 4% of the pool are delinquent. The loans, landings at Brittany Acres and 100 Riverbend, were both reported 30 days delinquent. The landings at Brittany Acres, which is backed by a 77-unit garden-style multi-family property in suburban St. Louis, Missouri, was 87.9% occupied as of February 23 rent roll, with an average rental rate of $9.94. The achieved rental rate represents a 16% increase over rents at issuance. So you see rents are going up in this environment. for these types of properties, for these types of projects, I should say, according to the collateral manager. Now, this is not Arbor. This is the collateral manager. The borrower will be required to replenish the interest reserve. The loan matures in April 2024 and includes two 12-month extension options. According to the collateral manager, the borrower for 100 Riverbend loan is expected to conduct a capital call with its investors to bring the loan current. Notice that's not Arbor that has to bring the loan current. The collateral manager is saying the borrower for 100 Riverbend is going to conduct a capital call with its investors to bring the loan current and to market the property for sale in September 2023 upon completion of the renovations. Maturity risk is concentrated in 2024 as collateral representing 65% of the pool is scheduled to mature. However, the majority of the loans have extension options ranging between 12 and 24 months. Only two loans representing 1.9% of the pool mature in 2023, and both include a 12-month extension option. So that, again, I read that and I think, yeah, but that kind of stuff is priced in already. We're well off the $19, $20 high that we saw last July 2022. We were at, I think, high 13s before the Viceroy short report came in. So even at $14, we're down $6 off the high. That is a 30% decrease in the price. Based on what I'm seeing, okay, that's fine, but it's certainly not, as Viceroy would say in its opening paragraph, a donut hole. They believe that ABR is a donut hole. It's zero. Notice what the collateral manager is saying here. The borrower is going to conduct a capital call. The borrower will have to replenish the interest reserve, not Arbor, the borrower. Okay, next paragraph. ABR retains the CLO equity tranches, which are consolidated under GAAP accounting. True. CLO debt has the advantage of locked-in match funding, but that insurance comes at a price. The most relevant covenant is the over-collateralization test. It requires the value of the assets in each CLO to maintain adequate cushion over the debt owed to bondholders. By design, in order to maximize returns to the residual holder, the over-collateralization is maintained very close to the minimum, true, which effectively requires Arbor to purchase out of the CLO at par any and all loans that run into trouble, as failing to do so will cause the structures to immediately trap cash, which means cash flow no longer flows to the residual holder. No, that is not true. It does not require Arbor to purchase the loans. Arbor can purchase the loans, but it doesn't have to. It can do a modification, meaning a capital, a restructuring of the capital by asking the borrower to initiate a capital call. A lot of this is on the borrower first. Arbor doesn't have to deal with it unless the borrower can't. So Arbor gets on the phone and says, hey, listen, we need a capital call. We need it in the next 3 days. If not, this is the stuff that we're going to have to do. But we need something to happen. And that's what would happen. And if that can't happen, then yes, at that point, Arbor would have to buy the loan. The average size of the loan that we've seen is about $30 million. The question is, does Arbor have the liquidity to buy the loan? Well, we've already seen it has $900 million on its balance sheet. So the next question would be, has Arbor had to buy loans out of the CLO? And if so, how many? Will cause immediately trapped cash, which means cash flow no longer flows to the residual holder. This is already happening. No, it is not. It is not happening. None of the CLOs are in breach at this point. None of them, and cash is flowing to all the tranches. This is not already happening. No, it is not. That could have been easily verified. And as described above, is very likely to occur at an accelerating and unlikely sustainable pace. Again, hyperbolic language based on an inadequate understanding. So you can discount that. Modifications are happening, but trapped cash, no, this is not already happening. And here, to buy the loan only if the over-collateralization test fails, which requires the loan to be impaired to some degree. Here is our CLO compliance tests as the most recent determined dates, October 2023. There's CLO 14 all the way through 19. Here is the limit 118.76. This is 119, over collateralized, even over the limit, pass, 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 pass. The interest coverage, there is the limit, 120, 153, 151, 148, 143, 148, 132. October 2023. This is from the Q3 2023 10Q, page 25. Read the notes and the next table that follows from this if you want more information on this, but look at that. Okay, let's get into the other financing. Arbor also finances 4.4 billion of assets using 3.2 billion of repo financing. Few funding sources are more volatile than repo funding, especially for opaque level 3 assets like bespoke bridge loans. Now that means you don't really have the transparency you want. Level 3 means you're using assumptions to get the pricing done. Bespoke means they're one-off, not standardized. Admittedly, these are not overnight lines, but they do require annual renewal, with maturity staggered from mid-23 through 2024. But as Arbor states in our 2022 10K, certain of our repurchase facilities include margin call provisions. Certain of them include margin call provisions. I'll show you which ones. Associated with changes in interest spreads, which are designed to limit the lender's credit exposure. If we experience significant decreases in the value of the property serving as collateral under these repurchase agreements, which is set by the lenders based on current market conditions, right? The value of the properties, which is set by the lender. The lenders have the right to require us to repay all or a portion of the funds advanced or provide additional collateral. So let's see how they're doing. This is their structured business. And they also have repos for the agency. We're going to ignore the agency because all of this seems to be focused on the structured business. This is the available amount. So 6.6 available. How much have they drawn? It's down here. 3.036 billion is drawn against 6.6 billion available. They got another almost 3.6 billion that they can draw on, along with the 900 million in cash they have on their balance sheet. So do they have a liquidity issue? No. Let's look at, actually this is 2 in 2033. What am I thinking? 2 in 2023. Here's the current maturity. July 25, August 25. This one here in 2023, note 6. Note 6 says they are in talks to extend this to 2025, and I believe that that is now done. But as of September 30th, 2023, they did not have that information. So this is extendable to 2025, as is this. This one here, 2024, 2024, 2024, and 2020. You got 4 in 2024, which total, if you look at the principal amount, 632 million in Q1. But they do have available room in their other credit facilities. If they can't get it done, they've got available room in their other credit facilities, plus they have 900 million in cash. So this is not going to cause a problem. You don't want to use the 900 million in cash for that, but that's why you build cash for these particular type of events. So is this going to take them down? No. No, if they use their own cash, well then here are the rates that their cash would be getting at that point. And since their cash is sitting in cash equivalents, it's probably getting a cash rate. If they take out the repo, they would be saving this. It would actually be accretive to earnings to use 632 million of their cash to repay those facilities. It would actually be accretive. If we look at what's Q2 of 2024, another 29 million, and Q3 of 2024, another 18 million, just with the cash that they have on hand as of September 30th, 900 million can take out every maturing repo in 2024. And that's not counting their cash flow from operations that will continue to build cash over that period of time. And that's not counting any loans that pay themselves out where they build cash on their balance sheet either. There is no fear at this point. What else do we have in here? 2025. 2025, 2026. And they can extend the maturities. This can be extended to 2026. Look at them all. 25, 26, 27, 25, 27. We've already seen the forward curve. And there is a belief, even if we listen to the Fed thinks that by 2026 they'll be at 3.5% on the Fed funds rate instead of 5.5. I don't see a problem here. I see plenty of cash to take this out. I see plenty of room, 6.6 billion. They've drawn 3.36 billion. So even if one said, oh, we want out, it's very probable that they can move to another one. This is 2.5 billion. They've used 923 million of it. You could move everything to there and still be well under the cap that you need. But even if you use cash to pay it out, their cash equivalents are certainly not paying these rates. It would be accretive to earnings if based on their current maturities, they could not roll it over. And if we go all the way out to 2025 and 2026, yeah, interest rates are going to be lower. Again, recall the forward curve, right? When you're looking at the maturities and what are they going to roll over at if the forward curve turns out to be right. As interest rates go down, these costs will also go down as well. Now, if we think about the collateral value, here's all the collateral against all of the outstanding balances. The collateral of 4.3 against 3.036, that is 144% over collateralized. The property value would have to be impaired by a significant amount to still not qualify, to still not be over collateralized. There is no problem here. Okay, to be fair, let's look at Q1 2023 because our author only had this to go on, said that a lot were maturing in 2023 and there were a lot maturing in 2023, but we can line them up. Each of them here we can line up and see how successful they were at extension. So notice number one here, the 2.5 current maturity March of 24, now is July of 25. That's just in 6 months because this is Q3 of 23. So in 6 months, what have they been able to do? Extend this from 24 to 25. Number two, December 23 is now August 25. Number three, August 23 is now, well, this is one that they're renegotiating to go a little bit further. This one here, based on the information on the conference call, has been extended. So that one is not maturing. There's the note number 6. Note number 6 is the extension on it. Number 4, October 23 is now January 24. Number 5, July 23 is now July 24. October 23 is now being extended to January 24. March 24 is now being extended to March 25. This one down here, April 26, still is at April 26, but notice you went from 25 million up to 40 million over a tough period of time. They're increasing their capacity and extending. They have good relationships with their repo counterparties. And that's what matters. If you have a good relationship, you can get things done. They're getting things done. So they've been successful from Q1 to Q3 of 2023 on extending their credit facilities. So they don't have a liquidity crunch coming in there. What is subject to margin call provisions? Anything with a 2. 1, 2, 3, 4 of these facilities are subject to margin call provisions. But again, look at the big one here, 2.5, March 24 to July 25. They got it extended, right? The debt carrying amount in March 24 was 1.336 billion. It is now 923 million, down some 400 million. Why would you not point that out, saying, look, they've been successful at extending this. They've got a lower amount in their repos that they're using, 3.6. Look down here for the total, 3.6. This also includes the agency business down here, 3.6. The structured business was 3.228. The structured business is now 3.036. Agency's fairly safe, so we're not really going to pay attention to the agency business because we're not really too concerned about that. It's the structured business. Not only did they get the amount lent down, but extended many of them. Plus, remember, they have $900 900 billion. Wouldn't that be nice? 900 million of cash on the balance sheet. Also, as far as these credit facilities and these repurchase facilities, there's a repo facility there, some are credit facilities. Read notes 3 and notes 5 that the end of the facility is 6 months after the lender gives notice. So let's say that this 500 million repurchase facility wants to end it. It would have to give notice, and it ends 6 months. They have a 6-month term. Once that 6 months is over, they have another 6 months to repurchase the loan. So they actually, built into the structure of these, have 12 months anyways. Okay, this is from Q3 2023, September 30th. This is asset class and risk rating. It has pass, pass watch, special mention, substandard, and doubtful. Banks like to make loans here. So what you don't want to see is a migration down. That is not what Arbor does. Arbor originates here. Arbor originates here and hopes for migration up. So we can't say, well, there's not much here. Holy geez, look at it. As further down you go, the worse it gets. It starts here. That's where they start. And then they look at success by, has it migrated up? So we have to read it from this line upwards. So the total, 4.5 is here. Look how much is here, 6.3. And some of it has made it all the way up to here. This is what you don't want to see, the substandard and doubtful. The substandard and doubtful add up to 491. A weighted average last dollar loan to value ratio, 78%. When we say last dollar, it means you're starting at the bottom of the capital stack, working up, you get to 78%. That's the last dollar. So there is 22% above that to get to the value. So let's gross it up to what the property value is. 491 divided by 0.78, you get to 630,000. If we look at the allowance for credit losses on multifamily, 89 million has already been taken. So we already have 89 million. So if we take the 491, which is the value of the loans that are substandard and doubtful, subtract what we've already charged off, 89 million, we get the 402, which means if all of the loans in here, and there are 13 loans in here, if all of these loans completely default and have to be liquidated, the liquidated value would have to be less than 64% of its current property value before any additional losses would be recorded, because we've already recorded 89 million of loan loss reserves against that. So it would have to drop quite a bit. If we want to be more specific, we wouldn't use the full 89. We'd go to the impaired table. We could see that 17.7 million has been allocated for that. Some of this substandard and doubtful is impaired. 90 million has a carrying value of 87.9, so it is impaired. So you do have to take an impairment charge for that. The allowance for credit losses against that are sitting at 17.75, which assumes 77% liquidation value of the loan, not of the property, but of the loan. If the carrying value is 87 and the unpaid principal is 90, we'd assume 77% of the 87 based on the allowance for credit loss for those specific assets. That's it. I mean, as far as what is standard, substandard, or doubtful, that's it. If you are concerned about, well, how much is sitting in special mention based on by origination year, if you're concerned about that, that's because they tend to originate there and then migrate up, right? 2023 by origination, you can see how low originations are here, 771. They basically stopped giving out loans. That's part of the balance sheet management at this point, and getting through this period of time is lowering risk. All good management would do that. Of the 4.6 over here, you can see how much has migrated up, 2.3 and 131. So for Arbor, you can't start at the top and work your way down. You have to start here and work your way up. This is success. Going from here to here. Going from here to here is not failure. It's just the wrong way to do it. Okay, this is where we end our long presentation. Allowance for loss sharing obligations under the Fannie Mae underwriter program, the DUS program. Ending balance for the 9 months ended September 30th over here. This is 69 million is what they have set aside for loss sharing obligations. Let's read some things here. When a loan is sold under the Fannie Mae DUS program, we undertake an obligation to partially guarantee the performance of the loan. I'm including this because the author does then go into how much exposure is still sitting over here at Fannie. Yes, there is exposure, but it's minimal. A liability is recognized for the fair value of the guarantee obligation undertaken. For the non-contingent aspect of the guarantee is removed only upon either the expiration or settlement of the guarantee. At September 30th, 2023, we had 34.6 million of guarantee obligations included in the allowance for loss sharing obligations. That's 34.6 million for the guarantee obligations. This CECL, this is the expected credit losses, in addition to and separately from the fair value of the guarantee, which we've seen up here. We estimate our allowance for loss sharing under CECL over the contract period in which we are exposed to credit risk. The current expected loss related to loss sharing was based on a collective pooling basis with similar risk characteristics, a reasonable and supported forecast, and a reversion period based on our average historical losses through the remaining contractual term of the portfolio. When we settle a loss under the DUS loss sharing model, the net loss is charged off against the previous recorded loss sharing obligation. The settled loss is often net of any previously advanced principal and interest payments in accordance with the DUS program, which are reflected as reductions to the proceeds needed to settle losses. At September 30th, we had an outstanding advance of 0.3 million respectively, which were netted against the allowance for loss sharing. So how this works is, if there is a particular loan in default, Arbor would have to forward 4 months of payments. It's not as if, there's a loss right now. You forward 4 months to keep it going to see if the problem can resolve itself. If it can't, and there has to be a liquidation, if there has to be somebody that steps in to liquidate it, then Arbor is responsible for the first 5% of the loss, and then there's loss sharing after that. So it's not as if they're on the hook for 100% of everything. There would have to be a significant broad scale effect in the market, especially in multifamily, which, yes, there are stresses in the market, but not like 2008. There would have to be some event like that to cause this to become a big problem. As of September 30th, 2023, our allowance for loss sharing obligations associated with expected losses under CECL was 34.7 million, represented 0.17% of our Fannie Mae servicing portfolio. During the 3 and 9 months ended September 30th, we recorded a 2.5 million and 11.9 million increase in CECL reserves. That's the reserve. That's not saying that we actually had to pay anything out. That's we've just increased our reserves. This last paragraph, I think, is important. As of September 30th, 2023, the maximum quantifiable liability associated with our guarantees under Fannie Mae DUS agreement was 3.79 billion. That's the maximum liability. Well, that would wipe out the equity. That would destroy Arbor 100%. However, the maximum quantifiable liability is not representative of the actual loss we would incur. We would be liable for this amount only if all the loans we service for Fannie Mae, for which we retain some risk of loss, were to default and all the collateral underlying these loans was determined to be without value at the time of settlement. So you would have to have 100% of the loans default, and you would have to have all the property value go to zero. Let me tell you something. If that happens, some event has happened in the US where your investment in Arbor, I guarantee you, is the least of the problems you're going to have to deal with in life. For all the properties and all the loans to go to zero, something bad has happened. A nuclear bomb has gone off everywhere across the US. Your investment in Arbor is the least of your concerns. Typically, if you're in the GSE program, you have met certain requirements to be there. You have serious operators that are there. Barring an exogenous event like 2008, where there was potentially a lot of mortgage fraud going on and low quality mortgages being put into the agency program, barring that happening again, that's not going to happen. The operators of the apartments, as we've seen, will make capital calls. They have equity at stake. They don't want to lose that. They're motivated operators. They'll make their capital calls. They'll do what they can to get loan modifications or workouts. But they do have a motivated group of people in the apartment buildings themselves. To date, given that we are sort of at the bottom of the credit cycle, meaning the tightest credit environment you could be in, at the peak of rates, and they've been coming down recently, and this is where Arbor is, with third quarter earnings that beat expectations, with 11 dividend raises in the last 13 quarters, with increasing their book value per share while increasing their loan loss reserves, with very few buyouts of loans from all of the CLO pools. I think they've done 2, where they've had to buy the loan out from the pool just to take it out. Loan modifications running about 15% in a very hostile environment at the bottom of the credit cycle, at the peak of rates. And this is it. This is your short report. This should have been written maybe in 2021 before rates started going up, saying if rates are going up, here's what's going to happen. What is missing from all of this is management's ability to navigate rough waters. You have, in Arbor, a very seasoned management team. Now, I want to show you one last thing before we go. This is Arbor Investor Relations SEC filings, and from here we have our Form 4's beneficial changes in ownership. November 20th. Let's have a look at this one. And what are we going to find here? Let's expand this. This is Paul. This is the CFO. A or D. A means acquired. D is dispose of securities acquired. 7,500 at 12/37. Amount of securities beneficially owned, 277,000 shares. Now, this purchase was just for a little under 100,000. And the date of this purchase was 11/16. The day of the short report, where the stock took a big hit. The CFO stepped in, said, I'll pick up 100,000. Now, if any of that were true, insiders would be selling, not buying. They would be selling. Now, you might say, well, maybe they're just trying to send a signal. Why would the CFO spend 100,000 of their own dollars to increase their exposure? Look at their exposure. And this is direct ownership as well. Why would they increase their exposure? 277. Let's close that one. Look at the one below it, November 9th. This is before the short report. Let's open that up. This is William Green. Acquired almost 5,000 shares at $13. And the transaction date was November 8th. This was after their earnings and before the short report. The insider now owns 152,000 shares after acquiring more. Why would, if there was this big problem looming, everyone within ABR would be aware of it. It would be the conversation of the day. Oh my God, everybody wants their money back. Nobody's paying us. Why would you spend 100,000 of your own money to buy shares? Let's close that one. Let's look at this one over here, November 8th, statement of changes in ownership. Click on that one. And who do we have? We have the CEO, Ivan Kaufman. What do you think he's doing? Look at that. He's buying shares. 10,000 on November 6th, 10,000 shares at 12.47. He now owns over 1 million shares. If there was an existential problem for ABR, if there was bad stuff going on, November 6th, would he be buying 10,000 more? This is before the short report came out. So insiders selling shares, 10,000 or 20,000 shares, doesn't really raise a lot of eyebrows. If there was something really wrong, you would think that they'd be selling. After the short report, you can make the argument, well, you wouldn't sell, it would look bad. But before it came out, before anyone was even aware of it coming out, this was their opportunity to sneak away. But acquisition, another 10,000 shares. Let's go to the next one here. Open this one up. Who do we have here? Kerry Wilkins. And what are we doing over here? Acquisition, 1,562. No price given on this one. But acquired 1,562 shares. There's also a Form 3. I think I would have to read the Form 3 and combine it with this one. But I think you see what's going on here is that you have insiders that are buying shares. They're not selling, they're buying. A typical short candidate will have usually a lot of insider sales. You will see insider sales going on. We're not seeing any insider sales going on here. We're seeing insider purchases. And in fact, in a bold move on the day the short report came out and the stock plunged, you had the CFO ponying up almost 100,000 of their own money to buy shares. So there we are. After we've gone through this, I leave the the Viceroy report to you. Start going through it and start reading it, knowing everything you know now, and you will see just the glaring misinformation that's presented, but that's the point. The point is not to inform, it's to inflame. They want to raise emotion within you. They're not appealing to your rational self, they're appealing to your emotional self. And that's going to be ignored by the institutional side, but not the retail side, but the institutional side. If you ever want to write a short report and you need the institutional side on your side, if you need them with you, don't write hyperbolically. Write with very few adjectives. Write with statements of fact, and make sure you do your research. And if there's good information out there, you're going to want to nullify the good information if you can. But as soon as you start writing hyperbolically, as soon as you start getting lazy, as soon as you fall in love with your idea and you just want it to be true, that you're only going to pay attention to stuff that you think makes your case, you're going to be ignored. So if you want to have effect, big effect, you got to write for an institutional market and not a retail market. If you're just trying to distort, which is what Viceroy does, it's short and distort, then you're not delivering information, you're delivering emotion. You will get a retail market reaction, but it's a scumbag way to live. It is intellectually dishonest, and the institutional market will generally ignore you. Anyways, I hope now you feel a lot better. If you are an Arbor shareholder, maybe you want to go through the Value Investor Club report and read it again. And this time, as you're reading it, you'll say, "Oh my God, you are way off on a lot of this stuff. You are way off." CFA Venger, I can only imagine, is a CFA, and based on what we've seen here, apparently this is a very elite club that even Wall Street pros have a tough time getting into this. That's an article from Barron's. I don't know. That was an easy takedown. Tell me what you think. All right, you can think of this section as sort of an appendix to the video. You don't have to watch it, but in this we're going to look briefly at the assumptions or the analysis criteria used for multifamily, for stabilized, and at interest rate stress. So this, I think, starts on page 24. It goes through all the different property types, but 24 is multifamily. which is what we're looking for. Here we are. Revenue analysis. Base rent, generally net residential income, based on the most recent annualized rent roll, is the starting point for determining a multifamily's stabilized net cash flow. Vacant units are typically grossed up at the market rental rate. Morningstar generally applies a vacancy rate equal to the greatest of the actual vacancy rate, the sub-market vacancy, or some minimum 5%. So you take all the units, you gross them up at the market, whatever vacant units are there, you gross them up at the market rental rate, figure out what the net residential income is, and then you adjust it for the actual vacancy rate. The resulting Morningstar stabilized NRI level is compared with and generally constrained to the T-12 collections. If new supply is expected to come online and compete directly with the subject, occupancy or rents may suffer. The new product will likely offer a lease-up special that will attract tenants from the subject property. Morningstar recognizes the additional stress this may cause and may take an additional vacancy factor. It is important to recognize what, if any, concessions are offered at the subject property and in the broader market. Considering current concessions, Morningstar will look at stabilized effective gross income figure. For example, if a 1-month free move-in special is commonplace in the market, Morningstar effectively reduces the annual rent by factoring in the concession. So this is how we're getting to the stabilized net cash flow. So when we look at what their stabilized loan to value or stabilized debt service coverage ratio, it has all of these assumptions in there. Management fee. Morningstar generally applies a management fee of 4% with a dollar amount cap that is generally not to exceed the greater of $1 million annually or a minimum of 1.5%. CapEx will be estimated based on the highest of the engineer's inflated recommendation per unit, actual collected annual reserves, and the minimum parameter of $250 per unit. So whichever one is the highest will be used for CapEx. And that is the assumptions that they make. Extremely conservative assumptions. And when I mean conservative, it means aggressive to the negative side, not to the positive side, not trying to make it look better than what it is, but so aggressive to make it look worse than what it could be. Let's have a look at the interest rate stresses and how they get the interest rate stress. And the methodology is down here. You start with a swap curve. Step 2, pay attention to this. Apply a volatility stress factor by multiplying the market implied volatilities from step 1 by 1.75. Where are we getting these volatilities? They're not actual interest rate volatilities, they're option implied volatilities. Where do we start with? We're using the volatilities from interest rate caps. It's described above, but you're using the volatilities from interest rate caps. The value implicitly incorporates a correction for log normal conversion and, while subjective, produces a wider distribution of potential interest rate paths. So we are, since we have loans are not like a bond, like a fixed rate bond that have known cash flows. Cash flows are interest rate dependent. You're going to need an interest rate tree to calculate what the cash flows would be at any point in time. If you increase the volatility, you increase the width of the tree, which means you make interest rates much higher than they would be and sometimes much lower than they would be. And then you do a Monte Carlo simulation on these. You're going to generate a sufficient number of interest rate paths for the course of 1-month LIBOR over 30-year or a 360-month horizon. So you can't possibly price anything out on a tree that big. You're going to take certain pathways, and you might take 1,000 different pathways, for example. To generate these paths, Morningstar implements the normal random process identified in the technical background, as well as the most recent closing U.S. swap curve and stressed U.S. interest rate cap volatilities from step 1. Notice that we are using, as I said, the volatilities from the options, from the interest rate caps, and we know that implied volatilities tend to overstate actual volatilities, and we're taking that implied volatility and multiplying it by 1.75 to get the spread in the tree. This is the important point here. Assigned to the current month, the interest rate from a vector in step 4A, which ranks at the confidence level for a given rating. For example, if the AAA rating sets forth 99.4% confidence level and you've generated 1,000 paths, assign the 6th highest rate to the current month. So what I'm going to do is I'm going to show you on the screen how that is done. But you have a very wide tree. For those of you who know what a binomial tree is, just imagine, remember we did some of this in level 2. When you increase the volatility, you increase the width of that tree. You make interest rates at the top of the tree higher and interest rates at the bottom of the tree lower, but because it's log normal, the volatility at the upper end of the, or at the top part of the tree will be much higher than those at the lower end. Remember, interest rates are constrained to 0 at the bottom. And then it says, okay, for every time period, month 1, month 2, month 3, month 4, if you've run 1,000 different pathways through there, look at all of the interest rates for month 1 that were simulated. Remember, that tree can go all the way up or all the way down because of the volatility, right? So rank all of those interest rates from month 1 from top to bottom, 1,000 of them, and if you're looking for 99.4, you're going to take the 6th highest interest rate. Then go to node 2 and take the 6th highest one. Go to node 3 and take the 6th highest one. So your stressed interest rate, as you can see, is really stressed. It's going to follow the upper part of the tree. Look what happens here. Rating curves at 1.7 times market implied volatility stress levels for AAA month. Out of the simulation that it gets based on where rates were when they did this, it was extremely low. But look where it went from sub 1%. And to judge AAA, you're discounting, you're suddenly using 7 to 7.5% interest rate. That's a stressed interest rate. And then you have your A all the way down to your C, which is going to be probably the equity or the very high yield portion. Look at how they've all just gone up over the course of time. This is a simulation, mind you. I'll show you on the screen how to get that done. But what it's doing at every single node is it's taking the highest, the higher of the rates, not the average of the rates at that point in time, and certainly not rates that would follow a forward path. I'll draw that out for you on a screen. Okay, let's see how we calculate the stressed interest rate that is used to calculate the interest rate for the debt service coverage ratio. Let's just start with an interest rate tree. They look like this. They're what are called recombining trees. It's a recombining lattice. For those CFA candidates, you've seen this in level 2 when we priced out a bond that has an embedded option. And these are forward rates. And these forward rates are based on the volatility of interest rates. So there is your current rate. And then we'll have a volatility factor that rates could increase to here or decrease to here. And for the third forward rate, the fourth forward rate, if we continued on in the tree, etc. Right? Well, we're going to use the implied volatility of a call that is on the, implied volatility on the cap. And implied volatilities typically are higher than historical volatilities. And we're not going to stop there. We're going to multiply that by 1.75. When you do that, the tree widens. So let's draw a wide tree, understanding that we are massively overstating volatility here. And the easiest way to get this done is like this. I'll just draw. I'm not drawing it out for precision. I'm just drawing it out for a very fast explanation of what we happen to be doing. I could do better than that. Let's see. There we go. Let's say it's there. Okay, and this is just for showing you what's going on, so don't worry that it doesn't look perfect. Remember, that's overstated volatility. Every node, this is time 1. There are time 2 forward rates, and here is, let's say that's time 24. I'm just doing it fast, but that would be two years in, time 24, all of the nodes. And then what you do is you randomly select a path. And you might say, okay, here we are, and interest rates will do this. And you might have something that selects the path, and there you go. So you would take your loan balance, because it's interest only, you calculate how much interest expense is here with this interest rate, then here, then here, then here, then here, then here, all the way through to calculate the monthly interest expense. And then you do it again, and again, and again, and again. You just make paths at random, and you do that like 1,000 times. And then at each time period here, you rank them from highest to lowest. And then you would have, if it's, let's say, the 95th, you'd go to the 95th percentile, which is, if you did 1,000 times 950 observations, you would count down. The 50th one from the top would be the interest rate you would use here. Then you do the same here, and you'll use the top 50th one out of 1,000. Then you do the same here. It's not hard to see that you'll concentrate your interest rates up here on a very wide tree that is 75% wider than the volatility it needs to be. Yeah, that's a stressed interest rate, right? So your numerator is your cash flow. Your denominator is your interest expense based on this very stressed rate. We've already seen that net cash flow is going to include within it the tenant unit improvements, which are a one-time deal and really not part of FFO. FFO would include maintenance CapEx, but certainly not capital CapEx. But NCF will include the capital CapEx. Your denominator, which is your interest expense, is massively overstated because it is a stressed interest rate. So when we look at the difference between what Morningstar says is the debt service coverage ratio based on its assumptions and what is provided by the sponsor, that being Arbor for the loans, it's inappropriate to say that Arbor is using really aggressive assumptions. It is more true that the net cash flow used by the rating agencies is understating the true cash flow, and that the interest expense used by the rating agencies is overstating the real interest expense because this is a stressed ratio. That bit of information is missing from the report, and those ratios are treated as if they are the ratios and that Arbor is the guilty party. If anything, you would look at these assumptions and say, but those are really aggressive assumptions, right? Yes, they are. Now, if you have a forward curve of 1 month SOFR that's downward sloping, and you're doing this because you're using a tree with volatility, you will still end up with higher future rates than lower future rates. So in an inverted yield curve scenario, the stressed interest rate is even more stressed because it's not taking into consideration the fact that you do have a downward sloping curve. Now, it is using these forward rates. In its defense, it's using these forward rates. But remember, it is taking the highest observation, so it is taking from the top of the tree, not from the bottom of the tree. So it's not following this path down, it's taking from the top of the tree.